I think when we left off, the case is still with the applicant.
Aqua calls to the witness stand Dylan DeSantis.
All right. Do you sincerely and solemnly swear that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth, so help you God? Please be seated. And Mr. Drews?
Mr. DeSantis, did you cause to be filed on June 30th, 2022, 79 pages of direct testimony along with 9 exhibits?
Yes, sir.
And do you have any corrections to that pre-filed testimony?
I do not.
Okay, and have you also prepared a written summary of your direct testimony?
I did.
Do you have any changes to that?
I do not.
Okay. We would ask that the pre-filed testimony from June 30th of Mr. DeSantis and his summary be incorporated into the record as if orally read from the stand.
Did you move the summary and the testimony? That motion will be allowed.
Thank you. And we would ask that his exhibits be identified as marked.
All right, that motion is also allowed.
Okay. And I don't know that I've even mentioned this to Mr. DeSantis, but on direct, we have decided to dispense with the reading out loud of the summary, but we will ask to read out loud on the rebuttal.
Mr. Drews, do we have our summaries? Were they distributed?
That's a good question. So have we?
We were getting them day by day was my understanding from you.
Okay. I left a big stack of those in the room across the hall on the assumption that they would magically be distributed. And
The magic of the Dobbs building
Right.
has changed since
Yeah.
you last.
my
lived here.
co-counsel is rescuing me here. She's running over there to get them.
All right, that's fine. You may continue.
Okay, well, at this point, if y'all don't mind us passing those out shortly, we would just go ahead and tender Mr. DeSantis for cross-examination.
All right.
Thank you, commissioners. Thank you, Mr. Drews. Mr. DeSantis, we've met before.
Yes, good to see you again. How are the
Good to see you.
holidays?
It was great. How are yours?
Pretty good.
Awesome. You're here today on the Aqua case.
Yes, sir.
And I learned a lesson from last time, and I have a copy of the exhibits that I propose to use in the chair, and they're also in that white notebook with tabs behind them. And I think you have a copy of your testimony in front of you. Am I right?
I do, sir.
Okay. If we could, let me think. I think it was a couple of months ago you were here for Carolina Water.
Yes, that sounds right.
And
December.
so you testify often, can we say, on behalf of regulated utilities.
Yes, you could.
And I didn't see on your resume where you testified on behalf of the public staff or its equivalent in other states.
No, but I have applied to be a witness or an expert for this commission, actually, for one of the fair value cases that was in front of the commission.
Was that application accepted in any state or this state?
No.
Have you? Okay. Let's start, if you don't mind, in the areas where the public staff and Aqua agree.
Sure.
So we agree that we should impute to Aqua North Carolina, Inc. and utilize in this proceeding a capital structure that's 50% equity stock and 50% long-term debt.
Yes, sir.
Okay, and I'm going to say equity, return on equity, ROE, common stock. Those are all the issues that I'm going to talk about today.
Don't worry. I'll correct you if you get one mixed up.
Please do. Thank you. I will save some cross-examination, just skip a little bit ahead. In your rebuttal testimony, you accept the public staff's long-term debt cost.
Yes, sir.
So the issue today before this commission is this equity component, right?
Yes, sir.
Okay. And we are going to use this 50-50 equity debt split for Aqua North Carolina, but Aqua North Carolina itself doesn't issue any stock, but its parent company does, correct? And that's a compound question. Let me start over. Okay. Aqua North Carolina Inc. does not itself issue to the general public any common stock.
Yes, they're held at 100% equity. They're financed by the parent company.
And the parent company is called now Essential Utilities.
Yes, I think there's one step in between. I think it's Aqua America, and then they're owned by Essential, but I don't think there's a difference.
The ultimate parent is Essential,
Absolutely,
and that is publicly traded on the New York Stock Exchange.
it is.
And Essential Utilities has a market cap of something like $12.5 billion.
Right, but obviously this company is significantly smaller than that.
Aqua North Carolina Inc., significantly smaller than $12.5 billion market cap.
Yes, sir.
Okay. So we've got what, 3.97% long-term debt, 50%. And then this 50% is the equity that I'd like to talk to you about now. You recommended 10.4%, correct?
I recommended a range of common equity cost rates, and then from that range, the company selected 10.40.
Okay. And that 10.40 would be used over WISP future years 1, 2, and 3, correct?
And is it, I'm not familiar, but is it the base year too? There's
There's a portion of the base year, but from now going forward would be the 10.4%, correct?
Yes, I agree with that.
Okay. And I'm not asking you to agree, but just for comparison's sake, Mr. Hinton said if a WSIP is used, the ROE should be 9.3, correct?
I agree that that's his position, yes.
Right. And I know you don't agree with his position. And then just for completeness sake, and I want to move on, 9.4, if there's a CAM, 9.5, if there's no WISP, no CAM, traditional rate making for Mr. Hinton.
That's his position, yes.
Okay. I would like to discuss with you the dollar impact of 10.4%, if you don't mind. And if you will turn to or look at Exhibit 1 behind Tab 1, which is the public staff's proposed cross exhibit number 1, please. And if you'll look on the second page,
All right, while we're here, we'll go ahead and identify it as Deascendus Direct, Cross-Examination Exhibit 1.
thank you, Commissioner. I'm sorry. I should have, I didn't mean to.
That's fine.
Deascendus Direct Cross-Examination Exhibit number 1, page 2 of 2. If you'll look near the bottom of the page, in discovery, the public staff asked Aqua to calculate the dollar impact. And if you'll see a little, I don't know if it's a chart, but the bullet points, a 1 basis point impact, parentheses, 0.01%, close parentheses, applied to Aqua's consolidated revenue requirement included in its rebuttal MFRs is as follows. Do you see where I am on this chart?
I do.
So we can agree that for rate year 1, I just want to look into the future, if you don't mind. Rate year 1, the future, using Aqua's numbers, a single basis point is $22,008.
Yes, sir.
So if I'm at, and 10.40% is 1,040 basis points.
Yeah, I see that. You're right.
Okay, I was doing some math. Now, I did actually put a calculator in that chair. If you'd like to follow along, I multiplied 1,040 basis points times $22,008 and got $22,888,320.
Because you're not using round numbers, you're using the difference between the two.
I was just doing the strict math.
And this is-
1040 times 22,008 gives you about $23 million.
Okay,
Is that right?
I'll accept your math. I don't.
Okay. So the impact of a 10.4% is, I'm going to go with round numbers, 23 million, but it's 22.8.
Okay,
Okay. If we subtract 110 basis points out, which coincidentally is the same number, the difference between you and Mr. Hinton, we get 110 times 22,008. We get $2,420,880.
that's the difference between us, right?
Correct.
So it's still $21 million in base year one.
Yes,
Okay.
roughly. I'm using round numbers. I don't like
Yeah,
that, but I will for you.
that's fine.
Okay. Can we agree that the dollar impact in future year one is $2,420,880, difference between you and Mr. Hinton?
So you're saying that the difference between our positions is around $2 million in the first year of the WISIP.
Correct.
I agree with that.
Okay. Second year, 2.536050. Third year, 2.663320. I'm sorry. I said point as well. 2,663,320. You add up those 3 years, you get $7,620,250. So can we agree that the difference over the 3-year WSIP future horizon between you and Mr. Hinton is about $7.6 million?
Over 3 years.
Correct.
Yeah, I agree to that math.
Thank you very much. Let me turn to a totally new topic then, if you don't mind.
Sure.
If you would turn with me to the second exhibit, which is behind tab 2. This is this is, I'd like to mark this as Deascendis Direct proposed cross exhibit number 2. Is that correct, Commissioner? I'm sorry.
Without the proposed, you're
Yes.
correct. Thank you.
Thank you. You'll recall that we have engaged in discovery in this case, and in August of 2022, Aqua provided a response to data request number 7, and this is the email that actually transmitted the response here. I just included it so you have the date in front of you.
Okay.
And that response actually had like more than 2,000 pages, so I don't want to talk about the whole thing with you. I've only put part of it here, but if you turn to page 3 of 4 of Exhibit 2, you'll see that you actually prepared the documents on page 4 of 4.
Yes, sir.
And so this is, we asked for the cases you've been involved in for the last decade or so, and this is your self-report of those cases, correct?
Water cases.
Apologize. Thank you. Water cases.
Yes, sir.
And when I was getting ready for today, I noticed that the 2021 Carolina water case is identified as ongoing. So I went back through and checked some of the ongoing ones that you highlighted in the original. And I found 4 more orders. So if you will, if I can, get you to turn to tab 3 with me. That's the what I would like to mark, Commissioner, Deascendis Direct cross exhibit number 3.
It will be so identified.
I told you, I think I found 4 cases that there had been orders issued, so I didn't include the orders. There are many, many pages. I've excerpted them. The first one is our case from our commission. If you'll look with me on page 2 of exhibit 3, I just highlighted there at paragraph 25, 9.40% was Carolina Water's return on equity.
Yes, as a result of the settlement, right?
I'm going to defer to actually, we
It-
probably
it
have people in
was.
this room who can tell us. Okay.
It was a settlement.
I'm going to say subject check like the witnesses always get to say.
There you go.
So if we could just flip forward through the rest of tab 3, if you'll look with me at page 5 of exhibit 3, Aquarion is 9.10. Page 8 of exhibit 3, Middlesex Water is at 9.6. And if you'll look at page 16, 9.5 for Aqua, Ohio.
Yes, sir. They're all subjects of settlements, and may or may not represent the true ROE as it's a product of negotiations between parties.
That's the ROE ordered by these four commissions, though.
Every single one of them, yes.
Okay. So I added them onto your spreadsheet. And if you will turn with me to Exhibit 4, which I would propose to mark commissioners as Deascendis Direct Cross Exhibit number 4. And what I've
So
done is,
identified.
oh, I'm sorry, Commissioner, thank you. What I've done here is I've taken the one that you emailed to us behind tab 2, and I've added in these 4 cases that I found. And I've taken out the columns about some of the little columns like cost to capital structure, because we agree on that, right? Just to make it more legible for my old eyes. And so this is your work with those 4 cases added in, and I highlighted them in this sort of dark color here so that you could see easily where I put them. Do you see what I've done there?
Yes, but like I said, you'd have to put the notation of the settlements on all of them, so they wouldn't be complete as,
You see these little ones here on the left? I should add a 1 for each of these 4 is what you're telling me. Is that right?
yes.
Okay.
So if you look at, I guess, the 4th from the bottom on page 1, that's a settlement. So right next to the 910, 9.10%, you'd put that as a settlement. And then the other highlighted cases on page 2, they're all also settlements.
So I'm going to add the little 1 in parentheses, which we know from your legend on page 2 means it's a settlement.
Thank you.
Okay. With that addition, now what I did was I went back in these 37 cases for which you had, and some of them I didn't take out because you were either rebuttal or there's been no order yet. But of the 37 where you proposed a number and the commission proposed a result, I went back and I averaged them. And what you did that was tricky is sometimes you proposed a range. So I took the low and the high, the low being the one sort of most favorable to you. And so if you'll look with me at page 2 of 2 of Exhibit 4, you'll see that the average amount that your ROE came in higher than the commission was 118 basis points.
But if you look at the ones next to it, there's 30 out of 37 are settlements.
Yes.
So when you look at it, it's not reflective of the ROE, it's reflective of negotiations between parties. So while the math may be correct in the bold underneath, it's also not applicable because those numbers aren't representative of a fully litigated case where ROE was fully litigated.
Okay. In the majority, maybe the vast majority of your cases, you have settled ROEs. Is that correct?
Yeah, 30 out of 37.
Right.
Looks like.
So I understand that you contend that the ROE is slightly less applicable because the case was settled. But putting that aside, can we agree that if we just look strictly at your filed testimony and strictly at the order that came out of the commissions or equivalent, for whatever reason, settlement, compromise, whatever, we've got 118 basis points.
The issue is that settlement, compromise, whatever actually means something, right? So there's give and take between the parties, and these cases are not representative of a fully litigated case. So if you looked at the other ones that weren't, now if you took and did that on the ones that weren't, maybe it would be different. If you look at the Carolina Water Service, which was halfway through the page in February 2018, there's a negative there, -5 to 0.45. And then there's a couple others where there are some and there are some not that are big and some are small, and that's based on the record in the case.
I noticed that of the 37, you managed to find the only one where you, on the lower end of your range, came in slightly below the order that came out of the commission. But if we just eyeballing it, I see a lot of ones here, a lot of 100 basis points above the commission's orders, even in the litigated cases. 1.6, 1.05, -0.5 to +45, 1.1, 1.22, 1.05, 1.5. We've got some basis points. I bet if we did the math, it would still be close to 100 basis points. But let's not do the math. Let's just agree that you strongly disagree with my assertion that these 30 are applicable. Is that a fair statement?
I would take that, yes.
Okay. Now, I'm subject to your very strong disagreement with my position. Mr. Hinton came in 110 basis points below you, didn't he? If there's a WSIP.
But if you're looking at what's actually happening in the case, the last case that Mr. Hinton testified to, in this case for Aqua, it was 50 basis points lower. So if you look at that case, and if you look at the Aqua case here, which I would assume is in Aqua, North Carolina. So if you take a look at Aqua, North Carolina, that was a settlement at 940. Mr. Hinton is now 50 basis points higher than that from this case to last case. So if you added 50 basis points onto that 9.4, you run into the bottom of my range, which is 9.9 for the base year. It also is equivalent to what Mr. Hinton came up with in his risk premium model.
Well, I'll let your lawyers make a little chart like this for Mr. Hinton and figure out what his deviation is. But I take your point. If we can now turn to the fifth tab, Deascendis Direct, which I propose to mark as exhibit identified as Deascendis Direct cross exhibit number 5.
All right, be so identified.
You actually saw this chart last time you testified. I just turned it sideways again so I could read it easier. This is from RRA cases for the last couple of years, 2021 and 2022. And you see the average 2021 reported is 9.46%, and the average 2022 reported is 9.59%.
I see that, and it shows a trend of upward pressure on ROEs, and it should be because of increasing interest rates and increasing inflation.
And I know that North Carolina actually is on this chart, but these are, other than that, non-North Carolina jurisdictions. I just wanted a survey. I'm not trying to use other states to determine our rates.
Yes, sir. This is more of a survey, and I agree with you that if you're looking at historical ROEs, you can look at them in a stable economic environment as a rule. But if you're looking at historical ROEs in a dynamic environment such as this one, it may not be applicable in the case. So,
thank you. If you would turn to tab 6, I propose to mark this document as Deascendis Direct cross-examination exhibit number 6.
All right, it'll be so identified.
I looked at your water cases for the last 2 years, sort of mirroring that thing. Average ROE 2021, 9.61. Average ROE for 2022, 9.47%. I know this is not a representative sample, but I just thought it was sort of interesting that they were fairly close to each other.
yes, and like I said, a lot of those are settled cases, and a lot of those are using data like the Aquarian Water Company in New Hampshire. That even though it was filed in December of 2020, that was using data in the middle of 2020. So there was a lot of pieces of the testimony that was significantly dated by the time the settlement went through.
Well, certainly by July of 2022, which doesn't seem that long ago to me, the commission is aware of the world as it exists when it issues an order, right?
But if you're going by the record in the case and you're going by the positions of the parties, and I didn't have rebuttal testimony in the case, so there wasn't any opportunity to update the numbers because they settled before rebuttal was filed. So there was a lot of things that they did that wouldn't reflect current markets.
And of course, I can't speak to other commissions, but certainly the commission doesn't just close their eyes. They're called on to use their expertise and awareness of the world around them when they issue their orders, aren't they?
I would think if it's a settlement, they go and they look at the number and the end result, and then they make a decision, yes or no.
Okay. let's talk about a totally new topic, if you don't mind.
Sure.
Um, Flotation costs?
Sure.
How do you spell that, please?
Flotation.
Okay, flotation.
Yeah, I misspelled with I had an A in the middle when I first started, and my boss was very upset with me after that.
That's why I thought it would be nice to have the correct spelling in the record. So your ROE calculations included 5 basis points for flotation costs.
Yes, sir.
So does that mean that your ROE is actually 10.35% and you added this 0.05% for this recovery?
So if you remember what we said earlier, there was, and I think the easiest way to look at it would be Exhibit DWD1, Schedule 1, Page 2, and that'll show like the breakdown and the adding and things like that.
I'm sorry, DWD1.
DWD1,
Yep.
Page 2. So on that schedule page, you'll see that I have my 4 model results and then the indicated range based on those model results. And then from there, I make adjustments. Well, I make one adjustment for the flotation costs, which then results in the company-specific range of cost of equity cost rates, from which the company selected 1040. So I don't know whether if I had the 5 basis points in or out, whether or not their number would be different.
The ranges that you generated after conducting your analyses included 0.05% for flotation costs.
Yes, sir.
And so we don't know how the company arrived at 10.4, but we know that when you presented with the ranges, they were all higher. The low and the upper end were all higher by 0.05% because you'd added in the flotation cost.
Yes, and maybe the question, if you wanted to ask it, you could ask Mr. Becker if the number would have changed given flotation costs or not.
I don't think he looks like he wants to leap into the middle of your testimony, but maybe I'm wrong.
I'm sure he's up on rebuttal in the next couple days.
Okay. Now, let's just take a pause and go back to my exhibit. My exhibit 1, which is that dollar value that we calculated for a basis point. Remember?
Yes, sir.
And so we said a years 1, 2, and 3, a basis point is worth $22,000 to $24,000. 5 of them is going to get you to $110,000 to $120,000 per year. If we just say, what are 5 basis points worth in years 1, 2, and 3, we're going to get $346,000
Over the 3 years. Yeah.
over 3 years.
Yes, I mean, your math is right, and I don't know what and if any impact that those 5 basis points had on management when they selected their ROE.
I understand. I just want to know what the value of 5 basis points is over 3 years, $346,000.
Right, but it's either 100,000 or 125,000, given which year it is.
A year.
Yes.
Yes. I guess it could actually be more if Aqua doesn't come in for a rate case.
And I think if you look down at underneath those bullets, it says 1 basis point is 1 cent per customer. That's the.
Oh,
Am I reading that correctly?
you're looking at exhibit 1.
Yes, I'm so under the bullet points in 1, page 2. So if you applied that 1 basis point, it's 1 penny or almost 2 pennies per month per customer. I think that's what, yeah, one penny, 2 pennies per month per customer.
I did not write this, but I absolutely agree with you. That's the language written on the page.
Okay. So then it's 12 to 15 cents per customer per month.
I understand. So when you got to the 0.05%, the 5 basis points, and I'm sure you know this, but if you'll look at DWD 9, that's how you calculated it, right?
Yes, sir.
And so what you did was you started with the DCF model, which is 9.03%, correct?
Yes, sir.
Well, I mean, if we stopped at 9.3%, we could all just leave today, but I expect you have other models that tell me why 9.03 is low, correct?
And I have updated models that supersede this, so.
Right. You use the average DCF here, 9.03. But when you are calculating the DCF, you actually use the mean. You did an average of the mean and the average. And if you want to see, you can look at, sorry, I just lost my place when I was doing that.
Yeah, I'm aware of what I
Okay.
did with that.
That gives you 9.37%.
Yes, sir.
Why do you do that?
So it's in my direct testimony, but I'll, do the Cliff Notes version for you.
This is your day. You talk as long as you want.
So you don't want that. I don't think the commissioners want that either. So when I do use the mean and the median, when I average the mean and the median, I want to make sure to take into account all of the results, but then mitigating the high and low outliers.
Okay.
So that's the reason when I use this portion in DWD 9 where I calculate the flotation costs, it's a little different because I think it's a little bit more complicated if I have two flotation costs and then add them together or divide them or average them. So it's a little different, but it's not really an inconsistency, I don't think.
Oh, I was honestly curious.
Okay.
Now, if you would mind turning with me to tab 8, which I would propose to mark commissioners as Deascendis Direct Cross-Examination Exhibit number 8.
We skipped 7. And is that good or, doesn't matter to me.
I'm coming back to 7.
Okay,
I'm just going slightly up. You made me think of something, so I'm going to turn the page if you don't mind.
sure.
Cross-Examination Exhibit number 8.
We're going to mark it 8.
Thank you very
All
much.
right.
It is the one
Identify.
that is entitled Topic Cost of Equity. Do you see that in front of you?
Yes, sir.
Okay. And you see the public staff asked Aqua in the discovery process for issuance expenses. And it's only one page. Aqua told us, I'm sorry, actually, Aqua itself had none, but Essential Utilities incurred $221,816. Do you see that there?
Yes, sir.
Now, that's for all of Essential. That's the $12.5 billion market cap company, right?
Yes, sir.
Okay, so hold your finger on 8, please, and just skip with me quickly to exhibit 10, to tab 10, which commission I would propose to mark as Deascendis Direct Cross-Examination Exhibit number 10.
All right, Mr. Freeman, you're going to come back and pick up these others that you're leaving out?
Absolutely, Commissioner.
All right, then I'll go with you and we'll identify it as number 10.
Thank you very much. I appreciate your patience. Number 10 identifies that Essential has 5.5 million people. If you see about Essential,
It doesn't have 5.5.
I apologize. It
Sorry,
serves, it
It
serves.
threw me off. I'm sorry.
My fault. That's poor language, and I blame myself. Essential serves approximately 5.5 million people across 10 states.
Yes, sir.
Okay. And we know that in North Carolina, Aqua, North Carolina serves approximately 321,000 people.
Okay.
So I'm just going to do some rough math. My calculator's there. That's about 5.8% of Aqua's customers are in North Carolina.
Right. But see, what you need to know about
Essentials customers, not Aqua's. But yes, what I need to know about.
flotation costs are that it wouldn't be treated as an expense, like an O&M expense, because it's similar to debt, but I'll get into that a little bit later. But it's the foregone opportunity to invest and put in capital. So when you have the expense, the flotation costs of $221,000 for 2021, it is now that $221,000 disappears, where it would otherwise be devoted to capital, which would then earn a return on that. So that's why you have to roll those expenses in the ROE and not roll them into expenses.
I see, and you're getting ahead of me just a minute. What I'm trying to do is figure out what proportion is fair to allocate to North Carolina of flotation costs for Essential, which is a huge company across many states.
I agree with that.
So 100% shouldn't fall on North Carolina, right?
No.
Some smaller number. We know 5.8% of the customers are here. Mr. Hinton did this calculation where he came up with 2.941%. I'll leave that for them to talk to him about. But I thought I'd use the 5.8 because I could understand customers divided by customers. That was easy math for me. If I do 5.8% of the costs from Exhibit 8, I get about, I'm going to use round numbers, about $13,000.
So like I said, what you're kind of missing here is that it's not dollars, it's percentage of total, net proceeds percentage. So whatever that 221 is, 221 is the numerator, right? And the full net or gross proceeds is the denominator. So when you issue debt or equity, doesn't matter.
Okay.
Okay. You incur expenses. Okay. So that expense is now no longer. And then the percentage of what is left, your net proceeds. So your gross proceeds minus your expenses is your net proceeds. That proportion is what you have to look at. The 21,000 versus 200,000 isn't what you look at when you look at flotation costs.
Can I put words in your mouth and you tell me if I'm wrong?
Go for it.
If, for example, we issue $2.2 million worth of stock and it costs us 10%, $220,000 to issue it, you'd say 90% was for the stock, 10% was for flotation costs.
Yes.
So are you positing that the Exhibit 8 is only the expenses and represents issuance of stock of some number larger that this is a percentage of?
Yes, sir.
And this is only the expenses?
Yes, sir.
Okay. I don't read it that way, and let me tell you why. Because it says the expense is incurred for Form S3 Universal Shelf Registration and for private placement totals. I'm not even sure any of this is flotation costs, quite honestly. I mean, private placement is not public stock offered to the public. It's for private placement, right?
Equity still comes out.
Okay.
And this isn't what I included in DWD9.
No, it's a much larger number, isn't it?
Well, their flotation costs for a publicly traded utility company. So this S3 is not the same or equivalent to what I have in DWD9.
Okay.
So we're talking apples and oranges, and we don't have enough information to calculate the flotation costs for this particular example that you have here.
Let's go back to my example. Let's do easy math. I want $1 million of stock. I'm going to issue $1 million of stock. The company gets $900,000, and the underwriters, the printers, the attorneys, they get $100,000, right?
Right.
So now the company has $900,000 of equity it can use to invest in a water treatment plant.
Right.
The $100,000 that went to the underwriter, the printer, the lawyer, and whatnot is a thing that we're going to call flotation costs. Is that right?
That's right.
Okay. And now that $100,000 should be recovered in equity, is what you say, right?
It's an adjustment to the cost of equity, and it's equivalent to the adjustment to the cost of debt. So you have flotation costs for your debt, and that's rolled into the effective cost of debt for every publicly traded utility company in the country. So then the difference, the only difference between flotation costs for equity and debt is that debt has a fixed term that you could amortize, which is usually 30 years. Equity is outstanding forever. So that's the only difference between flotation for stock and flotation for bonds. That's it.
Okay, so I have the $100,000. I've written a check to the printer. I've written a check to the lawyer. I've written a check to the underwriter. It's $100,000. I could show you those checks. Here's this 100,000. Are you telling me that I should be allowed as Aqua, as essential utilities, to recover more than $100,000 of the expenses that I incurred?
So that, like I said a little bit earlier, that $100,000 would otherwise be going to capital that would earn a return. So because of that, you would earn on that piece, and that little piece, that adjustment to the ROE is what I calculated in DWD9.
Okay, if I did a present value, which you could do over like an infinite horizon almost, or you could, for a small percentage, I could determine the present value cost of that $100,000, correct?
That's what the DCF models there.
Yeah.
Okay.
And so I could figure out that, and it's going to be, don't make me use the DCF model in my head, but that 100,000 would become, let's say, 110,000, 108,000.
I'm not sure.
The present value of $100,000 over the future.
Right.
It would be that number.
It would be higher than that number.
Okay. Lower than 200,000?
I don't know.
All right. Well, we'll have to make that little calculator work maybe during a break. But anyway, so that is a number, right? I can determine that number. I can put that number to 2 decimal places, couldn't I?
You have to find out the discount rate.
Perfect. Once I've done that, I can determine that number to 2 decimal places.
The adjustment is how you come up with the adjustment. Like that's how you come up with the impact of the difference of having that $100,000 and investing it versus having it disappear. And the thing is that the models that we use, me and Mr. Hinton, that we use to determine the cost of equity, capital asset pricing model, discounted cash flow, and risk premium models, they assume no transaction costs, which means no flotation costs. So because of that, you have to bring them back in at the end. Now, it only works for companies that are publicly traded. As in my Carolina water case, I didn't have flotation costs because they're not publicly traded.
Under your theory, wouldn't you risk recovering more dollars? Even adding in your present value, more dollars, you could run the risk of recovering more dollars than were actually spent or would have been spent on other projects.
Repeat the question, please.
All right, so remember my hypothetical $100,000? We'll add some money to take it out to the future, right? So if you recover, let's say $346,000, and you've got this $100,000 of actual expenses, don't you run a risk that by putting in equity, you've recovered or run the risk of recovering more than was actually incurred or avoided or could have been spent otherwise?
Well, it's not a risk, it's a reality, right? Because you have to recover, you're recovering that cost, and then you have to recover the return on that cost.
Right. But if you get more dollars in than the cost and the return on that cost, now you've benefited the shareholders at the expense of the ratepayers, right?
The money's not free, and you have to be able to recover that, where nobody will raise money anymore.
I give you that. I give you that money's not free. So I'm going to give you the amount you spent, plus I'm going to give you a little bit more because money's not free, right? I'm going to make that into a number here. And if we put it in ROE and the company does well for 3 or 4 years, it can recover more than this ball, which included the money spent and the money that would have been earned otherwise, right? That is a potential thing that can happen.
Theoretically, it's you're investing it into capital. The capital is outstanding in perpetuity, and because of that, you have to adjust your common equity cost rate, which also lasts into perpetuity. So it's still. First of all, I didn't see that in anybody else's testimony about doing said thing.
Well, you've given me 2 answers to a question I didn't ask. I just want to know if theoretically it's possible. If I'm recovering some amount of money on equity and I've got an amount here that I spent, plus I'm going to gross it up for this future thing, right? So I'm going to give you everything you say that you should have over here. If I look over here and this money is larger than this money, right? That is a possibility.
It's not the correct way to calculate the number. The number is calculated through the DCF model, and that's how it is. I mean, a person theoretically adding a discount rate to an expense doesn't take into account all the other moving parts that the DCF has.
I think we're talking past each other, but I am going to move on to a slightly different topic, if you're okay with that.
Sure.
Okay. I'm going to bring it back just for a minute, though, to real world numbers. Exhibit 8, expenses $221,816.
Over a denominator that we don't know.
Correct.
Okay.
That side of the table spent 221,816 by their own discovery response, right?
Right, but we don't know what they got out of it.
Totally don't know. And you and I just calculated 5 basis points over 3 years was $346,000, correct? It was a minute ago, but that was the number we came to.
Over 3 years, yes.
Okay, thank you. Now let's look at Exhibit 9, if you don't mind, behind tab 9. This is, I would propose to mark this, commissioners, as Deascendis Direct, cross exhibit number 9.
All right, it'll be so identified.
And I'd like to include in our discussion the Supreme Court of North Carolina and what they have to say about flotation costs. So if you'll look with me at page 4.
And just as a potential objection here, this witness is not an attorney, so not in a position to give legal analysis. I just offer that in anticipation, having looked at what this exhibit's about.
Okay. Please don't give any legal analysis, Mr. Deascendis.
I will try not. I'm sure somebody will give me directions otherwise if I am.
Well, I see 3 things with page 4 that the North Carolina Supreme Court is telling us about. If you can see, there's very faint highlighting here.
We're looking at page 4, sir.
Page 4. There's very faint highlighting on the right column. I don't know if you can see it or not, but do you see the sentence that says, as we noted?
Yes, sir.
As we noted on the first appeal, a 0.1% upward increment in Duke's rate of return on common equity costs ratepayers $4.2 million annually in additional rates. Historically, Duke's average costs per issuance of stock was $3.2 million. Do you see where I am in this?
Yes.
Exhibit 9. That gets back to my sort of spent versus earned issue. I think we've discussed that thoroughly. So I'm going to pause and just say, I told you there are 3 things I want to talk about. That's one of them. And we just sort of pulled that discussion forward and had it. The second thing I'd like to talk to you about is, you see in the same paragraph, exhibit 9, right column, I've highlighted very faintly the phrase, particularly the absence of any evidence that Duke intended to issue stock in the immediate future, comma, there's simply no substantial evidentiary support for the commission's addition of a 0.01% increment to Duke's rate of return on common equity to cover future stock issuance costs. I might have missed a word there, but do you see where I am?
Yes, and it seems like it says that there's absence of evidence, which would pertain to that record, not this one.
Okay, so let's go back now to 7, but keep your finger on that paragraph that you just talked about. And if we could look behind tab 7, there's a document there I would propose commissioners to mark as Deascendis Direct Cross Exhibit number 7.
All right, it'll be so identified.
That's actually an order from this commission. And if you'll look on page 3 of 4, again, very faintly highlighted, but the first sentence that this commission wrote in its order, this commission has previously concluded that without evidence in the record of plans to issue new common stock in the near term, an allowance for flotation costs is not justified. And there's a footnote that I'm not going to speak into the record. Do you see where I am?
Yes, again, I guess Ms. Sanford was one of the commissioners in that one, but it seems like it's evidence in the record versus that record versus this one.
I understand. How much stock is going to be issued
What, in this case?
by Aqua of North Carolina, Inc.?
It's more that the evidence in the record should show that it doesn't matter whether or not you're issuing during the test year. And I write about it in page 65 and 66 of my direct testimony. And it's about how, since equity is outstanding in the perpetuity, there is always a cost of equity based on flotation for the equity that was already issued in the past.
I understand your point. Can we agree that nowhere in the record, and I've read your testimony carefully, but nowhere in the record is there a dollar figure for that shows plan to issue new common stock in the near term?
I agree with you.
Thank you. Let's go back to exhibit. Let's go back to, I'm sorry. We are at exhibit 9, which is the case, and the footnote 4, which I've highlighted here. And this is where the nerd in me comes out. I think it's kind of fascinating that the Supreme Court kind of went out of its way to throw a footnote here and say it is not necessary on this appeal for us to consider the interesting question of whether the costs of issuing stock should be included as an operating expense rather than an adjustment to the annual rate of return on common equity. That's sort of the third point that the Supreme Court is telling us to think about when we're looking at flotation costs. So I told you there'd be 3. Those are 1, 2, and 3.
Always 3s.
We've been talking about Aqua, but Essential, which you remember from tab 11, exhibit 10 behind tab 10. Essential has increased its dividend 32 times in the last 31 years and issued a 7% increase in its dividend from the one prior. And that is all at a 9.4% rate from the prior case sub 526 here, correct?
Let's try that again. What did you?
W-218 sub 526, 9.4% was for Carolina Water of North Carolina, Inc.
Yes.
Under that rate-making order, Essential issued a dividend that was a 7% increase and was a quarterly dividend, cash dividend that had been paid for 78 years. And that dividend has increased 32 times in the last 31 years.
Okay, and that's not based solely on the 9.4 ROE in this case, especially when you said that it was 5.8% of total customers, correct?
I totally agree.
Okay, and then if you look at Schedule DWD pages 2 through 8, you'll see yeah, I'll wait until you get
Which
there.
DWD was it?
So it's DWD 3 pages 2 through
Okay.
8. They're
yeah.
They're the value line sheets of the proxy group companies. And you'll see that if you take a look at the historical dividend growth rates for those companies, they're all around that 7% number. So what Essential is doing, dividend raises and things like that, that it's common and accepted throughout the water industry to have a growth rate of 7% on their dividends over the past several years. And there are several, including York Water Company, that was out of my rebuttal testimony. They've raised dividends for the last 100 years, raised them every year, 100 years. So I mean, it's one of those things where you look at that as an investor and you say, all right, well, these are predictable growing dividends that I want to invest in.
Yeah, I think this commission is doing its job great. Let me move on to a totally different topic. Are you still okay?
Oh, yeah.
Okay. You used three methodologies when you were kind of trying to figure out your ROE. Discounted cash flow model, risk premium model, and like a cost of equity model or models.
Capital asset pricing model.
That's what you'd call the last one? A
Yes.
CAPM?
Yes.
And sometimes you call it an ECAPM?
It's a variant of the CAPM.
And actually, you created the ECAPM variant that you used, didn't you? Or you wrote a paper and a bunch of people?
I did not. That's the predictive risk premium model.
Oh, I'm sorry. That's
And
what.
I didn't create it. It was based off of Nobel Prize winning work by Robert Ng.
That's
So
the one where you wrote the paper.
I did not. The first paper was written by Dr. Mickelfelder. I was a research associate.
Yes.
Then several papers after I co-authored, but that was based on applications of that model.
I understand. So three models: CAPM, risk premium, discounted cash flow, sometimes called DCF.
Yes, sir.
Okay. And you use both of these in your direct and rebuttal testimony.
The three of them?
You updated them.
Yeah, you said both of them. The three of them, yes.
Thank you. You
And
used three.
I applied them to both my utility proxy group and my non-utility proxy group.
The DCF model is kind of what we touched on before, this theory that investors pay for the stream of future stream of dividends to be paid to them, right?
Yes, sir.
And that was the 9.03, but when you average the mean and median, you got to 9.37%.
Right, and it was updated in my rebuttal testimony.
Yeah, and I will.
We'll get there, I'm sure.
And maybe we can spend some more time going through these methods on rebuttal, but I just wanted to sort of touch on them now and then get into the details a bit more.
Sure.
Okay. But if you'd like to, okay. I agree with you that you updated all these, and I'm not trying to hide that at all. If you'll turn with me to tab 11, and commissioners, I would propose to mark this one as the Ascendus Direct Cross Exhibit number 11.
All right.
And if you'll look at there's a paragraph beginning at the top, the commission gives no weight. And if you look at the last sentence in that, you see witness Hever.
Yeah, I think the entire page 85 is a good barometer. The commission in this case rejected the DCF models for being low side outliers and the CAPM for being high side outliers. And then it looks like they were, and if it's, you have the DCF is rejected and the CAPM is rejected, then you have one left. And that's the risk premium results. And if you look at those results, Mr. Hinton's is 9.94, which is inside the range of my initial recommendation.
I want to get a little more detailed right now, if you don't
Sure.
mind. On page 3 of 4 of Exhibit 11, we can see that the commission rejected the use of a DCF model that was based on earnings per share growth projections without consideration of historical results because it is upwardly biased and unreliable. Do you see where that's written on this page?
And I think that is based on the DCF of the market, not the DCF on the S&P 500, not the DCF on the proxy group companies. Because if they were too high and biased for the proxy group companies, then the DCF results wouldn't be low side outliers.
Here's what I'd like to say then. You're giving an answer to a question I didn't quite ask. First, let me go a little more basic so we can be on the same page. Can we agree that you do not use historical results?
For what?
You took out the Zacks forward-looking one. Remember the ones that Mr. Hinton included?
So, like I said, this paragraph is talking about the market risk premium, which is based on a DCF analysis. And it says in the order that they rejected Mr. Hevert's, which isn't me, his CAPM, because he didn't consider historical measures in his risk premium.
Yes.
I do.
You,
So if you take a look at Schedule DWD 5, page 5 of 5. So measure 1, measure 2, and measure 3 all use historical market risk premiums to derive the market equity risk premium for my CAPM analysis. So this portion of the order doesn't apply to my CAPM as long as, because Mr. Hevert, he solely relied on the projected growth in EPS for his market risk premiums. Now, I do have them in my calculation. They're actually measures 5 and 6, but I have used historical measures for my market risk premium in this case and consistently throughout my career.
what I'd like to do is ask you about some of Mr. Hinton's exhibits, but I think I'll do that on rebuttal.
Okay.
So let's pause this discussion and just say that one commission, one time in Exhibit 3 was concerned that failure to include historical results could be bad for models.
It was for one particular reason based on the MRP, and there are several pieces of evidence which unfortunately aren't in the record that shows that the bigger the company is, the more accurate and less biased the growth rates are.
Okay. So I'd like to talk about another method now, if you're ready to move on.
Sure.
The predictive risk premium model.
Okay.
And that is the theory that people invest in equity if they get some amount of the value to compensate them for the risk of equity ownership.
Can you say that again, please?
I'm trying to summarize what it means quickly for the commission.
Okay.
There's a risk of owning equity and people need to be compensated for that. So you're trying to pull that out.
Yes, that's a theory of just the risk premium model in general.
Right. I was trying to be very basic. A
Okay.
discounted cash flow, discounted. The DCF model looks to dividend streams. Predictive risk premium model looks to sort of the volatility of owning stocks. No, that's not the risk of compensating people for taking on the risk of owning equity.
That is the risk premium model, yes.
Okay. So if you'll look with me at DWD 4 of your direct testimony.
What page?
Oh, goodness. It's going to be like pretty late in your testimony.
Okay.
I don't know, like 70 pages in maybe? Do you see DWD 4?
Oh, so that header should have DWD4 page X of Y. Do you have that in the upper right
I
corner?
see what you're saying. Yes. Okay. Yeah. If you'll start with, there's a couple of them I want to look at, but if you'll start with page 2 of 16. DWD, I'm sorry, I did not understand what you were asking me. DWD-4, page 2 of 16, your direct testimony.
I'm there.
Okay. 1, 2, 3, 4, 5. You've got these companies here: American States Water, American Water Works, California Essential, Middlesex, SJW, and the York Water Company. Right?
Yes, sir.
And if we read across, now what you're doing here is you're trying to compute. This is the second method. This is the predictive risk premium model, correct?
It is, yes, it's the predictive risk premium model. It is one of the two models that I use to derive my recommendation for the risk premium model.
And what we've done here for American Water Works Company, if you'll look with me at column 7, indicated ROE, you wrote NMF, which means not meaningful figure.
Right.
You have excluded Waterworks Company from this.
I did.
You didn't, you know how I knew that is because I looked at this NMF and I read it down here. That's the way that you figure that out.
That's how those exhibits are supposed to work.
Well, I went back and added in what it would have been, and American Water Works would have been 19.23% if we add up your numbers.
Now, the reason why it's an NMF is because it fails a 2 standard deviation test for an outlier. I
Is
don't
that-
have it there, but that's why it's an NMF.
Okay. So your model has an unwritten rule in it that there's a 2 standard deviation test, and if you're out beyond it, you throw it out, right? Okay.
Generally.
Okay. I wish that had been written somewhere in your testimony so I could have looked it up. Because you told us a little bit earlier that you were trying to mitigate the highs and lows by averaging the median and the average together. So you actually have got a couple of mitigations. One is throwing things out if they're 2 standard deviations, and the averaging of median and average, right?
Yes, it all serves to make my recommendation more conservative than it may actually be.
It sounds like there's a lot of judgment that's just being shoveled into a thing called a predictive risk premium method by Mr. Diascendis.
It's math.
But you make a lot of judgment calls in what goes into this formula, including excluding this one with 3 little teeny letters.
Okay.
If we put it back in to the average, we would have gotten to 12.82%. And if we ripple forward for the next several years, if we put American Water Works back in, you've gotten numbers of 20%, 20.34%. And if we put these numbers back in, this model would have suggested averages of 12, 13, 13 and a half, almost 14%. And that is too large, so you didn't use it, right?
I eliminated American Water Works Company's PRPM results because it failed a 2 standard deviation test.
Okay. I'd now like to talk about a third. 3 models, right? The total market approach risk premium model. And that uses future interest rates, compares corporate bonds to stock prices, and then from that you try to derive an equity component, right?
In this case, I use 4 different measures. One is the current rate, the others are projected rates.
I'd like to talk about this a little bit more after Mr. Hinton's testimony is entered into the record. So just, there's a preview for you. You can act surprised when it comes up. Let's talk about CAPM, Capital Asset Pricing Model. This is the third model. Now, I think I misspoke just a minute ago. I meant to say the total market approach risk premium model. You have 2 versions of the risk premium model. One is the total market approach, right?
One of the 2, yes.
Okay. So you got three models. One of them has part two methods that you use to calculate it. I'd now like to talk about the third one, CAPM, capital asset pricing model. And here we're going to use the S&P 500 as a expected long-term rate of return on the market.
There are several measures of the market return that I use. There's several measures of the market risk premium that I use. It is not simplified to just the DCF on the S&P 500.
Okay. What I'd like to do, you use interest rates here too as well.
Yes.
I didn't mean to cut you off, but that's
Yes, I use current interest rates and I use projected interest rates.
right. You use several components.
And they're all updated, obviously.
Right.
So,
So I think what I'll do is talk about this third method a little bit more after we've updated it and Mr. Hinton's testimony is in the record, if that's okay with you.
it's fine with me. You're asking the questions. I'm just answering them.
Okay. Just I want to touch on this briefly and then move on. You also did a non-utility proxy group.
Yes, sir.
And I think we can agree those companies are radically different than Aqua, right? Northrop Grumman, Monster Beverage, UPS.
I think the industries may be different, but my argument and my mathematics and what I have to my selection criteria, which takes measures of market risk and non-market risk. And since the companies that I select have to pass both hurdles, so they have to have both similar market risk and similar non-market risk to be one of the companies. So if you look at market risk and non-market risk, you add them together and you get total risk. So while when you look at it compared to the utility proxy group, these names don't look like utilities, right? But when you look at the risk behind them, if you look at their betas, if you look at say Northrop Grumman, like things like that, like there's a lot of things that are kind of utility adjacent, but like I said, they're similar in total risk based on my measures.
I liked your phrase, so I'm going to adopt it. Different industries, but different, similar risk profiles. Is that how you?
That's exactly right.
Okay. Commissioners, if I could have a few minutes, I think I'm near the close. If I could just consult with my colleagues for a minute. Thank you. Thank you, Commissioners. I don't have any more questions.
See you tomorrow.
Wait, I'm sorry. I do need to move my exhibits into evidence. Is this the?
No, just hold on. Let's go through.
Okay.
Redirect.
Yes, I do have a few redirects. Thank you. Mr. DeSantis, you were asked a series of questions about public staff cross exhibits 2, 3, and 4. And I wanted to follow up on that. Some of those cases you indicate involved settlements, the ROE decisions for utilities in other jurisdictions, and even in this jurisdiction for other cases. In your experience, do settlements often involve, for lack of a better word, horse trading between the parties on different dollar issues?
Yes.
And so is it possible in a settlement that the ROE number might be reflection more of concessions made on other issues than the actual investor requirements?
Yes, sir.
Okay. I think this is shown in your exhibits, but I want to ask you if you know, did Aqua, Pennsylvania have a fully litigated case in April of 2022?
They did.
Do you know offhand what the authorized ROE coming out of that was?
It was 10%.
And was there an upward adjustment in that case, to your knowledge?
There was.
And what was that for?
It's for management efficiency.
Okay, thank you. Since you filed your direct, and potentially if you were to update your models, what direction has the cost of capital moved?
We'll see in my rebuttal testimony that the cost of capital moved significantly higher based on movements in interest rates and inflation and things like that. So,
And notwithstanding that increase in cost of capital, the company is still requesting a 10.4% ROE.
that's right. Even I think my rebuttal testimony, my range that is indicated by the models are higher than what the company is asking for in this case.
You were asked a series of questions about flotation cost. And you talked about how with debt, you have a fixed term and those costs can be amortized. Is that right?
Yes.
Okay. Is the same true for equity?
No.
Okay. Is that essentially a perpetual cost of it to the company, carrying cost on the issuance expense?
Yes, sir. Like I said, there was, when you have that cost, it stays with you. It's a lack of an investment. So every dime that you spend, or dime that you have to spend on issuing your equity, it's gone forever. And because of that, you don't get to recover that within the ROE models or anything that has to do with regulatory recovery. So that's one of the things that is different between the debt and equity flotation costs.
So just to make sure this clear, when there's an issuance expense for, or I should say issuance cost for equity, the company never recovers that through amortization or depreciation. Is that right?
Never.
Okay. And that's why it's an ongoing opportunity cost.
That's right.
Okay, thank you. Is that opportunity cost true for all equity the company has issued versus like in one of these exhibits, one-time issuance cost?
So since equity is outstanding in perpetuity, all of the past equity issuances would also need to be recovered going forward.
And for that reason, does the $221,000 issuance expense in that one situation they showed reflect in any way the actual flotation cost that this company, Aqua, has on its books?
No, and like I said, you don't have anything from what it's relative to. So the 221,000 can be issuance costs for an equity issuance of $1 million, and then you have a 20% flotation cost. So you don't have you don't have all of the data to make an adjustment based on the data in that cross exhibit.
If you know, where is this issuance cost recorded by the company? Is it in their capital accounts or is it an expense item?
It's in their capital accounts.
If you give me just a second here. You were asked a couple questions about the growth of dividend payments by Essential Utilities, the parent of Aqua, North Carolina, since they were last granted a 9.4% ROE here in North Carolina. And I wanted to ask you about the difference between dividends and earnings. Can you explain that difference? I'll do open-ended question here.
I don't, so you pay your dividends through earnings. So you have to have earnings enough for you to be able to pay your shareholders.
Can earnings, a portion of earnings also be plowed back into the company, like as retained earnings, if they're not paid as dividends?
Yes, sir, that's what happens.
And are utilities generally considered more to be income stocks than growth stocks?
They are considered income stocks, but but they have in the last couple, if you look at the value line sheet from, I think, July, there's something that says water utilities are no longer income stocks because their dividend yields are so low.
Well, is it important to management at utilities to show dividend growth because of past expectations of investors that it be more reflective as an income stock?
Absolutely.
Okay, thank you. You were asked about one particular case in the past where the commission ruled the DCF results were too low and the CAPM results were too high. Do you know if this commission, or for that matter, any commission, adopts one model with one set of inputs and uses that forever, or do they really kind of look at different results and different models from case to case?
It depends on where you are. There are some commissions that do have kind of fixed inputs, and then you kind of argue around the margins on how the inputs are. But and some rely on one model. This commission, which I've seen multiple occasions, they rightly look at everything and then make their decisions based on the record and based on the inputs. And that's the way that it should be, because all cost of equity models have their faults. And that's the reason why you have to use a lot of them. And because of that, commissions that are able to consider everything and not pigeonhole them into, say, I need you to look at historical growth rates or whatever, or current interest rates, that gives the commission enough ammunition to see the investor required rate of return.
Thank you. That's all my redirect.
All right, Mr. DeSantis. Just a couple questions here, and I'll see if my fellow commissioners have questions after. Can you give me any examples of the other jurisdictions that have provided a flotation cost adjustment in their ROE calculation?
Off the top of my head, Minnesota does. That's the only one I know. There are more, but Minnesota does.
And can you talk about, help us understand if we would be in line with their thinking, the similarities between the case, and what was the reason?
So the Minnesota Commission, their staff uses the same calculation that I use in that, and use the same reasoning behind it. So it's more that the company is forgoing their investment. I mean, it's not forgoing investment, but it's one of those things where the cost of floating the equity is causing them to forgo investment, and because of that, and since it's not able to be recovered in say depreciation or amortization or any of the ROE models, because the ROE models don't reflect transaction costs. That's why they approve an adjustment to the ROE based on that DCF model adjustment.
All right, and then what is the relevance of the fact that a significant amount of Aqua's, North Carolina's book equity is in the form of retained earnings and not capital that's raised from the investor?
That means that they're not getting a lot of capital infusions from the parent. If you have more retained earnings than common equity, that means that they're making money from their operations and not relying on the parent to operate.
Any other significance?
They might not be paying a lot of dividends up to the parent, but I don't know that for sure. But if you have a lot of retained earnings, you're probably a very well-run company.
All right. And can you reconcile the difference for us? If you look at Mr. Hinton's testimony on page 41, where he talks about the equity capital raised, he has a figure of $221,816. And we read your schedule DWD 9 is to say 308 million in that same in 2021. Do you know why there's a difference?
Well, I think that Mr. Hinton is quoting that exhibit. I think it was 8, but give me a second here. But it was the C3, and my DWD 9 reflects an equity offering on August 9th, which is different from what Mr. Hinton used. So that's the difference. And the flotation costs there were approximately $8.5 million. But I think that SEC file document is in my work papers. So and we provided that to staff in response to discovery, so I could pinpoint where it is well, I'll be here tomorrow. So if I could point you to it.
All right. And I want to go back to my second question for a minute. So with the retained, with the company's book equity being in the form of retained earnings, is that an indication that money is being used for Aqua, North Carolina?
Yes, because if it wasn't used by Aqua, North Carolina, it would have been paid as a dividend out. So that money that is coming in for the retained earnings would be the plowback, like Mr. Drews was saying. So what's left after your earnings is what you reinvest into the company.
Okay. Questions from the commission? Commissioner Duffley.
Good afternoon. Quick clarification question. You were talking about the Aqua, Pennsylvania case
Yeah.
from 2022, and you mentioned that the 10% ROE included an upward adjustment for management efficiency. And my clarification is the 10% includes that upward adjustment?
That's right.
And then what was it prior to the upward adjustment?
Now you're testing my memory. I don't know that one. I know it's below, I think it was in the realm of 15 to 25 basis points, but I would have to check.
Okay, thank you. If you would, check. That would be
Sure.
good.
Chair Mitchell.
And then
Oh,
I have
I'm sorry.
you.
I'm sorry. Sorry. Jumped the gun.
And then you stated that you did not add flotation costs to the CWS case
Yes.
because it's not a publicly traded company. Do you add flotation costs for every utility that is publicly traded? And if not, why not?
I do.
Okay. One more. Oh, no, that's from a different matter. Thank you for that. Well, hold on, I have one more. Could you just describe for me further this 2 standard deviation test?
Sure. So you would take the average, and then you take so if you look at, you would take so if you went to EWD for page 2,
Mhm.
You would take the average of all of them, so including the American Water one.
Mm-hmm.
You would take the average and then you would find the standard deviation of that number. You'd multiply it by 2, and then you have goalposts,
Got it.
high and low.
Thank you. I appreciate that. I don't have anything further.
Now, Chair Mitchell.
Just a few, one follow-up on Commissioner Duffley's question about flotation costs. The adjustment you make in the publicly traded companies group, what is the adjustment that you make for flotation costs?
Oh, so if you look at 9, it's just 5. It's 5 basis points.
Okay, so, and you use that across the board for each company?
It's company specific. So say if Duke filed, I would have Duke's specific flotation costs from their SEC filed documents, and then I'd make that calculation.
Okay, so I understand you've used 5 here,
Yes,
but what you're saying is you use the specific costs incurred by the company
that's
for
right.
okay, just make sure the record is clear. Okay. I'm looking at the public staff's exhibit. It's the RRA data. It's number 5, behind tab number 5, if you can get your hands on it. It's cross-examination exhibit.
Two, 3, 4, 5. All right.
You see it's the RRA table.
Yep.
Okay. Did I hear you correctly? Let me start my question over. I heard you respond on redirect to a question from Mr. Drews about the cost of capital since you filed your testimony in this case. Do you remember that question he asked you?
Yes, and yes,
Okay, and you filed your testimony on June 30th of
That's-
2022, is that right?
that's right.
And you indicated that since that time, the cost of capital has increased.
Yes.
Okay, so looking at the page 2 of the RRA table, I see New Jersey and Ohio are cases that were resolved or settled in late 2022 or late-ish 2022. And both of those ROEs are significantly lower than what than the high end of your range or the number that the company has requested in this case. Can you square that with your response to Mr. Drews regarding the cost of capital?
Yeah, so generally, if you look at the models from where I started, I think my spot data was as of May, and from then to now, I would say, and my numbers show that the cost of equity has gone up. If you look at the numbers here, the bold numbers, you could also see that it's going up about 15 basis points just as a directional indicator. Now, those cases are settled cases, and like I said, the Aquarian case was using 2019 data.
Well, I'm specifically interested, I guess, in New Jersey and Ohio.
Right. So again, their settlement, so there may be an amount of horse trading there. But I do think that when we put together my recommendation, the bottom of my recommendation in this case was 9.9, which is not very far from that 9.6. The 10.4 that the company asked for obviously is higher than that and is closer to that 10% in the Aqua, Pennsylvania case.
Okay. So are these settled upon ROEs not inconsistent? That's a double negative, but they are not inconsistent with your response to Mr. Drews?
I don't think so. I think that they're one of those things where it's going up, but it's not going up as much as the models show, just like when interest rates were going down in 2019 and 20, and the authorized ROEs didn't go down as fast as interest rates did. So I think as time goes on, it may be inching up or not. If you look in New Jersey, 9.6 has been the settled ROE for the last 7 years. So so that 9.6, if you went back into any any authorized ROE for New Jersey for the last 6 or 7 years, it's 9.6. Doesn't matter if you're electric, gas, water, doesn't matter recession, doesn't matter pandemic, doesn't matter super high inflation, it's 9.6. So that there's some parts of some utility commissions, sometimes they don't move as fast as others.
Okay. You were involved in the Aqua, Ohio case, correct?
I was.
Does Ohio have similar regulatory mechanisms in effect for the water utilities, specifically multi-year rate plan projected?
I don't know for sure. Give me a second. I do have something in my rebuttal testament that would show.
I'll ask you that question on rebuttal, so we don't waste time today. You can track that down and respond to the question on rebuttal.
It was right here. It has an investment tracker, a new capital investment tracker, but it doesn't look like it has a forward-looking test year or formula rates or anything like that.
So does that mean it has a historic test year?
I think it's a known and measurable change of state. So then you'll go as far as the record will take you.
Understood. Okay. But it's not formula.
No.
Okay. All right, one last question for you. What is your, what can you tell me about the extent to which investors in utilities such as water, wastewater utilities consider cost burden to customers? I specifically mean, to what extent do investors take into consideration in rate increases, proposed rate increases?
Affordability issues.
Yes.
It's usually not what the investor looks at when it comes to requiring a return, because if you're looking at it, it's an opportunity cost. And when you're looking at the models and what they present, they kind of don't reflect affordability issues. It isn't one of those. And now it would affect, say, economic conditions, right? So because the economic conditions are reflected in market data, but to any extent other than that, I don't think so.
So equity investors aren't going to be, I just want to make sure I understand your testimony. Equity investors are not going to consider affordability?
They would as it pertains to economic conditions generally. So say if you're looking at essential utilities and you say, all right, well, they operate in 9 states. What is that looking like there? And then they'll make their adjustments. The price will change, and then those models change with it.
So do I understand you correctly that an investor, an equity investor would consider the economic condition of the state, the burden on the customer in that particular state to cover the water bill,
I think
given the economic one?
I think I'm sorry for cutting you off. I think it's more generally, it's more, if you're in states that have states in places where it might be harder than the average to kind of make ends meet, that I would think that would be reflected in their prices. And I think if you look at, say, your bad debt, bad debt and things like that, I'm sure the equity investors look at that because that's very important.
Right. So I'm not, and that's really what my question goes to. To what extent does the equity, at what point does the equity investor become concerned about the customer's ability to pay its bills?
I don't know if that comes into play. I think it's more, you're looking at financial conditions at the company level for that publicly traded company. Obviously, it's not, all right, well, here's essential utilities. Let's look at, the 5% of customers in North Carolina. It's more, all right, well, let's see it all as a whole.
Okay. Okay. All right, that's all I have. Thank you.
Thank you.
Commissioner Hughes.
Reconcile your trying to reconcile your views of risk with the companies. And you know, I understand. I think this is on page 68 of 79 of your pre-filed direct, where when asked about the WISIP for the multi-year and risk, you say that it better matches future revenues to future expenses and does not affect the volatility of those revenues or resultant earnings. And then on the top of that paragraph, you define risk can be defined as volatility in revenues and earnings. I'm interpreting, and both in this case, but just since I've been on the commission, that regulatory lag is a financial risk that utilities are concerned about. And the company has testimony throughout its application and that the WISIP will reduce regulatory lag. And I can just read you an example. And we talked a little bit about this yesterday. I don't know if you heard Mr. Becker's testimony, but we used this word, reduce ROE dilution. That's what they hope that a WISIP does, or that a WISIP is designed to. They further go to say that the WISIP is designed to better match rate revenues with corresponding investments and expenses rather than only using the historic test year for rate making models. So I understand that's a little bit of what you said, the WISIP does as well, but help me understand why that doesn't reduce risk. If moving forward, there's going to be less regulatory lag. There's been more alignment with the revenues, and I think you probably meant, you know, revenues and expenditures, which the ratio, not the ratio, but the difference between those is essentially going to be earnings. I'm having a hard time seeing why a WISIP wouldn't reduce the risk of volatile earnings moving forward. I would think a WISIP does what a lot of people hope and say that it would do, which is reduce regulatory lag and make revenues and expenditures, and therefore the difference between revenues and expenditures, more predictable moving forward.
Right, and thanks for that. It's not that I don't think it's going to reduce regulatory lag. It's more, is that mechanism, is WISIP going to put North Carolina utilities, either one, in a less risky credit profile as compared to your comparator companies? I don't think so. But I do agree with the company and Mr. Hinton and the rest of the folks that the WISIP will reduce regulatory lag. But the key argument is, what does that do relative to everybody else? It is my position that there is enough of WISIP type mechanisms, whether it be fully forecasted test year or infrastructure riders, that it doesn't affect the investor required return because it is already subsumed in market prices. So that's where I think the disconnect between me and Mr. Hinton is, because I think we both agree that there's going to be some regulatory lag mitigation. The actual consumptions and things like that, we don't have any control over. But when you talk about regulatory lag and matching revenues with expenses, and I think that absolutely does what it's set out to do. Now, I don't think now I think there's a difference in North Carolina versus other commissions in other jurisdictions where you call it a collar, where you have high side protection for customers and downside protection for the company. And it's usually accompanied by a true up, a revenue true up, where this commission or this state or whatever, I guess, application doesn't have that. The rule doesn't have that bottom side protection. So the difference between this MYRP and maybe others in around the country, there's that true up on the bottom that protects the company. So it's a not congruent risk sharing there. But if it works the way it's supposed to work, you would think that regulatory risk would go down, or regulatory lag would go down.
I appreciate that. And you cover that part in a different question, but you cover a lot about how difficult it is to compare a utility with outside utilities. So let's just compare two utilities. The Aqua, in this case, Aqua with the WISIP and Aqua without. I mean, if you look at the proposal, from what I can see, there's been presented to us what their rates would look like, what their revenue would look like, what their earnings would look like starting January 1st under the historic model, which is not a WISIP, and under what they're asking for. And there's a very material difference. I don't know if I have the final numbers because there's been a lot of changing, but millions of dollars difference starting next year. So those are two different situations. An investor looking at a decision that leads to multiple $1 million more next year than another decision with the same expenditures, doesn't that get rewarded in some way? By them accepting a lower REO? I just, the way I look at my personal investments, if I know I can get 5 million next year versus 3 million next year, I'm not quite in that investment level yet, but hoping to someday. It just seems, if you could say all things equal, next year I'm going to get a couple $1 million more. It just seems like, to me, I would be willing to accept a lower interest rate.
Right, but
I'm investing the same amount of money.
If you're looking, but the thing is that investors look at more than just with and without. There are going to be other utilities that already have it. So if you're looking at, and a lot of this is in my rebuttal testimony at that last exhibit, but a lot of the publicly traded utility companies that we have in our proxy groups, they have these mechanisms in place that have that kind of $1 million impact. And since we're using those companies' market data to determine the ROE, that's where we have to look at that data, because if you think about ROE as a comparative exercise, you have to make sure that one thing is more risky or less risky than the group that you're determining the ROE for. My opinion is that because there is so many publicly traded utility group or utility companies in my proxy group that have and reflect that millions of dollars of additional increases based on reduced regulatory lag, whether it be fully forecasted test year, infrastructure riders, decoupling, multi-year rate plans, like they're all encompassed in the market data. So, I mean, now I have co-authored an article on decoupling and infrastructure mechanisms and the effect of that on ROE. And it's my position that even if you look at it, the investor required rate of return does not significantly change based on whether or not it is authorized a decoupling mechanism or an infrastructure rider. Now, I know that's probably, some people would say no, some people would say yes on that. But if you didn't subscribe to that and you think that those mechanisms reduce risk and it's a tangible number reduction based on the approval of those of that, then for all these years where the company has been working on a historical test year, then they should have gotten a adder to their ROE. But I don't subscribe to that. But that's if we're thinking of it, if you're looking at these mechanisms are increasing risk or decreasing risk, the companies that did business in North Carolina would be riskier as compared to the rest of the companies in the proxy group based on the mechanisms that they have compared to what the company has.
Well, just let me see if I paraphrase it, our entire conversation. So with the models that you're using, they can't distinguish between Aqua with a WSIP and Aqua without a WSIP. So the models can't distinguish this multi-million-dollar difference would come next year.
Yes, that's what the subject of that paper was.
Okay. So the models that you've done, kind of saying this is what you should choose, they're just not, refined enough to actually see the difference between Aqua with a WSIP and Aqua without.
Right. So if you have it, yeah, it's just when we measured it, it wasn't statistically significant one way or the other.
Okay. I got it.
Okay.
Chairman Chu, you have a follow-up?
Just so I'm clear, just following on the conversation you were having with Commissioner Hughes, first, do you disagree that North Carolina has always been identified as at least a supportive regulatory environment for its investor-owned utilities?
Oh, yes.
And maybe even more than simply supportive. I don't know. Some folks around here would know better than I, but this jurisdiction has always been supportive, correct?
Absolutely.
Even with the old-fashioned historic test year.
Yes, and I haven't ever, in my testimonies, in my dozen testimonies that I've had in North Carolina, I've never said that there was any type of issue of regulatory risk as it comes to the commission.
Okay. And do you agree, or isn't it the case that this new statute under which Aqua has made application, which involves the multi-year rate setting as well as projections in establishing the revenue requirement and the rates, is a change from the old-fashioned historic test year?
Yes.
And the rate making paradigm we utilized under previously.
Yes.
Okay. And so I hear you responding to Commissioner Hughes that the new rate making mechanism that we're utilizing now, this multi-year rate plan that involves significant projection, doesn't reduce the company's risk, doesn't improve the company's credit worthiness in the eyes of the rating agencies or in the minds of the investors. Am I hearing that correctly?
No.
Okay.
It's more, and I think I thought I made myself clear, but it does reduce regulatory lag, which would decrease their risk. The issue that is before you guys is Aqua North Carolina less risky to the point of significantly less risky than the proxy group companies. So I agree with Commissioner Hughes that the change to the MYRP is a good thing for not only the the utility, but the customers. And that works out that so does a bunch of other regulatory jurisdictions in which my proxy group is using. So it's not that the company, I think, is less risky, but you have to compare the company with your proxy group company, because that's where you're getting all the models and the results and things like that. So it's a comparative exercise. The difference between an ROE, say if, all right, so if, say this was the first time anybody's ever done this in the country, and nobody else had any other mitigating adjustments or mechanisms, then that would put these companies at a unique risk, a unique lesser risk than the rest of your proxy group companies. That is not the case here. It is the authorized, the companies that comprise the proxy group have those type of mechanisms in place. So because of that, the ROEs models, the things that produce the results of those models already reflect the lower risk of the MYRP. Does that clarify?
It does. And so am I understanding you correctly that the model takes into account the regulatory mechanisms in effect in the jurisdictions of the companies that you're modeling?
Absolutely.
And makes some kind of determination about the risk mitigating effects or the effectiveness of those regulatory mechanisms?
That's right. That's absolutely right.
Okay. Okay. And just sort of humor me on this one. Maybe I'll save this one for later, but I'll save it for later. But I do want to follow up on one thing you said. You indicated that this mechanism, this multi-year with projection, is better for the company and better for the customers. Help me understand why it's better for the customers.
Well, the customers will know, so you're getting stepped increases over an amount of time, so you're not getting into rate shock. I mean, the key to the thing is that the consumers have to pay the cost of service, right? So I mean, so that's the one thing, but the consumers or the customers, they know well in advance what their rates are going to be. They could plan around them. And then I don't know, that's more of a policy witness question, but that's, I mean, that's one of those things where you can make plans about it. You can know what's being added and subtracted from rate base. You could figure out why your bill's the way it is. It's a lot more transparent as opposed to rate cases every year and you don't know what's going on. So there's a lot of, maybe it's cold comfort, right? The rates are going up, but at least you know by how much and when.
Okay, but in terms of any impact to the company's credit worthiness or ability to access capital at certain times or at certain costs, this mechanism, I mean, can you speak to any benefits to the customer that this mechanism would provide?
For what I have seen, there has not been any credit rating upgrade based on the approval of any regulatory mechanism, including a multi-year rate plan. So if we're talking about a lower cost of capital on the debt side, it's not there, and that should speak to the cost of equity as well. There has been no change in cost of debt. There shouldn't be a change in cost of equity either.
Okay, all right, thank you.
Yep.
Commissioner Hughes has a follow-up.
Well, I think we're all getting the same place, but your answer to Chair Mitchell is that the existence of multi-year, forward-year test years, all of those are taken into consideration in your model.
Yes.
In one way, I trust that the world's out there and they've already, those, for the other utilities, it's been baked in. You know, that help me just wrap my brain around, we have Aqua. If we had, just by coincidence, a completely identical company to Aqua with the exact same circumstances that was Water Inc., and you put water, and the only difference is that Aqua is in a state that has a historic test year, and Water Inc. is in a state that has this multi-year forward rate case. If you put those two in your model, is the output going to be at all different between those two?
You're going to hate this answer, but it depends on the analyst. So like I said, if I believe that regulatory mechanisms materially affected the rate of return, then I would say that the one with the historical test year would be a higher ROE. And because you would be comparing them to a proxy group that has ubiquitous amounts of that in their market data. Okay. So that's the issue. Like the MYRP and all these mechanisms, that's the baseline.
Okay, got it. So for your answer is that they would come out the same, with you being the analyst, they'd come out the exact same.
Yes.
Okay.
Thank you.
Commissioner Cameron,
Good afternoon. I just want to follow up on a question that Commissioner Brown Bland asked. And she had asked about examples of any jurisdictions that have approved flotation cost adjustment. And you mentioned Minnesota. So the converse of that question is, what about jurisdictions that have declined to approve flotation cost adjustments? Can you, in your experience, tell us what jurisdictions have refused to do so?
That's a longer list. I do know a couple off the top of my head, Delaware, Texas. I mean, here you guys haven't approved it in a while. But it's a longer list. There's definitely more jurisdictions that disapprove of the flotation costs than do.
And can you quantify the general number of what the longer list would be? Can you give us kind of a general number of jurisdictions? If you can, if you can't, then I'll just accept a longer list.
I mean, it would be speculation, but if it's a, you know, there's 50 states in the union, it's probably 40-10 not to yes.
And then your response that North Carolina has not approved a flotation cost adjustment led me to the other question I was going to ask you. I think that I went back and did a little bit of analysis for the past Aqua's past rate cases, and I think that you testified in the last two, I believe, in sub 497 that the order was issued in 2018, and then sub 526 the order was issued in 2020. Is that that's my understanding? Is that?
I think that's right. I don't know if I've done more or not, but usually them and Carolina Water, they file at the same time, so it gets everybody confused.
Right. And so in looking back through the orders and the settlement in the last rate case, the settlement did not include a flotation cost adjustment, and then the previous order in 2018 also did not include a flotation cost adjustment. Is there something about the issuance of common stock in this proceeding that would distinguish it from the others? Is there any difference that we should be aware of from past circumstances when the commission and the parties did not agree to that adjustment?
So I don't think there is, because it looks like in the 2020 case, there was an issuance of equity. In 2021, it looks like there's an issuance of equity. So there would be issuances close to the test year. So I don't think so. It's more the theory and accepting the theory or not. And that testimony's on the on the record. So it may be different testimony, but it's the same, at least, process to put it together.
Thank you.
I had one follow-up to the earlier question from Chair Mitchell. She asked you about affordability essentially as a risk. And you may have, and that, whether the investor considers that, and you may have answered that when you spoke to the economic conditions, you said that's where it's considered. But the investors, don't the investors consider it in some way or another when they're looking at the stability of the company and its ability to hit its numbers, whether it's going to price its customers out of being able to afford the service? Is that a consideration? It's not a.
I don't think they consider it. I don't. I think the general economic conditions, mostly what we put together in the very end of the testimony when we talk about economic conditions in North Carolina as compared to the United States. I think that investors in different companies probably look at the pieces and then put them together and figure out general economic conditions of the operations of the states that they're in.
All right. Any more questions from commission? All right. We're going to have questions on commission's questions right after a break. So let's come back at 3:25. All right, before we move on to questions or commission's questions, Commissioner definitely has another question.
So just one more follow-up on, Chair Mitchell was asking you as well as Commissioner Brown about affordability issues and increase of rates year after year. And I guess the question, and you talk about comparative groups, right? And bumping up group because increased risk or bumping down a group for decreased risk. Have you ever known a situation where a company has increased rates year after year after year by 30%, 20%, and affordability becomes an issue and they're bumped up to that next higher risk group?
I haven't. I haven't. I mean, it's one thing about affordability, but if it costs that much to serve those clients or the customers, it's hard to do that. So, I mean, the revenue requirement's based on cost. Now, I guess where you can balance that out would be through the ROE.
Okay, and you mentioned, and I hear you talk about cost base, but the affordability piece of it, have you ever had a situation where the rates became unaffordable and there was action taken? The increased risk bumped them up to a next level group.
Not in my experience, but I think when you talk about but it's for cost of equity witnesses, it's the cost of equity and it's based on that. But I think generally where the commission comes in is balancing the interests of ratepayers in the company, and I think that's more in your court than mine.
Okay, thank you for that.
Yeah.
And I should have said, Commissioner Duffley, and I have a question. So my other question is, it's a follow-up to my own question. When I asked you about the $308 million that is in your DWD Schedule 9, and that was with regard to a 2021 cost of equity. How much of that 308 million was used here by Aqua, North Carolina? Do you have any information?
Yeah. So if you look at Schedule DWD 9, page 1 of 1, if you take a look at the flotation cost percentage on the far right corner, or far right column 5, on the top row, you'll see that that's when I was talking with Mr. Freeman about needing a numerator and denominator to find the percentage costs. That's where you find it. So if you take that average cost on that fourth line down, which is 2.54%, you then run it through the flotation cost adjustment. So if you take a look at column 10, so column 10 is that second bottom half of the schedule, and right underneath column 4. If you take that percentage, you'll adjust that number for that adjusts the DCF for flotation costs. So that's where you get the adjustment. So the adjustment's not dollar amount, it's the percentage of the flotation of the issue. Now, theoretically, since Aqua North Carolina is funded by Aqua America or Essential, that percentage would be evenly distributed throughout all of their operating subsidiaries. So if it's 2.75% of $300 million or 2.75% of $200,000, it's the same percent, and it would be the same adjustment to the DCF.
So you're saying it is evenly distributed?
Yeah.
So that 308 million is evenly distributed?
I guess it'd be proportional. So it's theoretically, since you're using that equity to fund operations at the operating subsidiaries, that flotation costs would flow in proportion to what they get from the company. So that 2.75% is locked in for all of the capital that was apportioned out to each subsidiary. So that 275 number is the number, the relevant number in this case, not the 300 or any of the actual dollar amounts. It's more the percentages.
All right, thank you. So questions on commission's questions, starting with public staff?
Thank you, Commissioner. There's sort of three broad topics I'd like to address. One of them is, I guess they're sort of all related. One of them that came up is, what do other states do? And if you don't mind, I'd like to address that with you a little further after our direct testimony comes in before the commission.
Okay.
The second broad topic is, how do we measure these risk inputs? What effect does it have on the stock price and the debt price? And again, if you don't mind, we've pre-filed some exhibits and there's some testimony I want to give from our people before I discuss that with you further, if that's okay.
That's fine.
The third broad topic is, you said that the model accounted for these issues. I believe that it specifically came up in Chair Mitchell's questions to you. And I just want to make sure I understood your answer. When you look at the DCF model, you have your components divided by, add G or K, I forgot what you called yours, your constant. Anyway, none of those, there is no item within the formula you use where you make an adjustment for whether or not there's a multi-year rate plan or some kind of future recovery. What your model accounts for it in the fact that the inputs, according to you, have already addressed those issues within them. Am I correct about that?
Right. If you made an adjustment for, say, a multi-year rate plan or mechanism, it would be a double count.
Okay. So let me say, if I can say it a little simpler, you don't put a plus X in your formulas. You just assume that when you input the proxy group, it's already in their stock price. It's already in their dividends. It's already in their risk.
I wouldn't say assume. I would say that the market data reflects the mechanisms that are employed by the companies in the proxy group.
So you're relying on the market data, not a separate adjustment that you make.
That's right.
Thank you. If we could just pause for one. Thank you. I don't have any more questions.
See you tomorrow.
All right, questions on the commission's questions from the company?
Yes, and at the risk of offending my witness here, I'm going to follow up on that last one. Am I right or wrong in thinking that the models you use show the returns that investors expect for all known risk?
Yes.
And do you know,
I'm sorry, was that yes or no that Mr.
Yeah.
Drews was correct? Or
Yes.
okay.
do you have an idea of how long the multi-year rate statute has been known in North Carolina?
North Carolina, I want to say that it was at least 2021. I don't know the exact date, but
Subject to check.
subject to check.
Okay.
I think it's in 2021 sometime.
Thanks. You were asked several questions about affordability. And I guess one thing, this economic concept, I don't know that you have any data or not on it, but do you have a sense of how much elasticity there is for water and sewer service? Elasticity of demand by consumers?
I mean, it's very inelastic.
Okay. And if there were consumers who could not pay their utility bills. Is there some protection for investors in the form of bad debt expense, uncollectibles that's built into rates?
Yes, and I think there's also protection for customers. I think there's a LIWAP that was just approved I think it was over the pandemic or shortly thereafter. So with affordability, you also have that low income protection for that service. So there's two ways that if a person doesn't pay their bill, the company's protected and the customer is also protected.
I don't know if you've read other testimony. Are you aware the company has proposed a customer assistance program in addition to LIWAP for its low-income customers who are having issues paying their bills in this case?
I didn't read that, but
Okay. You were asked by Commissioner Hughes a question, I think, about his portfolio where he's going to make millions more if he owned your stock, the essential stock. And more seriously, what I want to ask on that is, under the multi-year rate plan, if the company is adding millions of dollars of new capital additions in a future year, if that's approved for rate recovery, can you explain the difference between those millions of additional rate base and the actual return that would be recovered in rates?
well, I mean, it should go without saying that returns aren't guaranteed by the commission or anywhere, and this multi-year plan is no exception. So, and I haven't looked at it very often, but I know that Aqua, North Carolina has not earned their authorized rate of return for several years, if ever. So I mean, it doesn't, this multi-year rate plan doesn't guarantee any type of rate of return. So the millions that Commissioner Hughes was banking on may not actually exist in reality.
And I guess I want to ask that in a different way too. So let's assume just hypothetically that the rate year one was going to involve an additional capital amount of $10 million for a round number going into rate base. Would the company recover 10 million in that rate year one, or would they recover the 7% return plus depreciation expense on that 10 million?
The latter.
Okay,
It'd be
thank
the
you.
return on.
Thank you.
Yeah.
Okay, that's just to clarify. You were, I think, asked this by Chair Mitchell. I just wanted to clarify again. Among your proxy companies, do some have multi-year rate plan type mechanisms and some do not?
Yes. So
Okay.
do you want me to go? So if you look at the proxy group, and this is in my rebuttal, it's scheduled DWD 6R. If you look at that the first column with X's on it, you'll see the fully forecasted future test year, which is similar to what the company is asking for in this filing. And we'll start at Golden State's Water. That's California. They have had multi-year rate plans since the 1980s. So American States, California Water, whose operations are not solely based in California, but majority and substantially in California, all of that market data would reflect multi-year rate plans. And the difference between the multi-year rate plans in California with what we're asking for, what the company is asking for, is that their multi-year rate plans are backed by decoupling too. So if you have that collar, if you have that 100 basis points on each side collar, where over 100 basis points the customer gets it. Under 100 basis points, they true up the revenue for next year so that they can recover that. In this case, there is no safety net, which is a benefit to customers, which is one of the I think Commissioner Brown Bland asked about protections for customers. That's another protection for customers. Where was it you or was I forget who it was? But anyway, that's a protection for customers. There is no true up mechanism underneath of the bottom of the collar. If you continue to go forward, Pennsylvania has a fully forecasted future test year. That is the major holding of essential utilities. So that proxy group company would also be reflected. That data, the market data, would be reflected in that market data. And then if you go further down the list, you have Iowa, Tennessee, Virginia, and those are all subsidiaries of American Water. And then if you look at we'll just go with the fully forecasted test year. But as you can see on this schedule, the vast majority of companies have some sort of reflection in a multi-year rate plan. So because of that, there shouldn't be any type of risk reduction based on the ROE, because we're using these companies to calculate the models.
So in response to some commission questions, you indicated that if the WISIP, the multi-year plan, is approved, there can be reduced regulatory lag, which is a benefit to the company. Is that correct?
Yes.
Is it, to your knowledge, in other states where there's been a similar mechanism, have there been any upgrades to the credit ratings as a result of those mechanisms?
No.
And in this case, would the multi-year plan benefit customers in the sense that there would be less frequent rate cases and regulatory expense?
If everything goes to plan, yes. If the company earns within that 200 basis point bogey, it would, because they wouldn't file it. There wouldn't be a trigger to file a rate case.
So what you've called the 200 basis point bogey is a reference to the banding of up to 100 points on either side of the authorized ROE?
That's right, sir.
Okay. And if the company exceeds the 100 points on the upper side, what happens to the earnings above that upper band?
It goes 100% to the customer.
And if the company under earns beyond the 100-point band on the lower side, what happens in terms of, is the company entitled to a surcharge?
No, they have the opportunity to, so they have no, like I said, when we were talking about California's multi-year rate plan, they're underneath, they're under 100 bogey. So if they earn under 100, they have a revenue true up in those mechanisms. So the company doesn't have that. They have the opportunity to file another rate case, but not under multi-year rate plan. They have to file it using the historical test year, which, like Commissioner Hughes said, there's a big difference between the filing numbers between those two types of cases.
And if they did under earn by more than the lower band, then at that point, they would have to put together the test year, the rate case, wait for the hearing of the decision. Would that entail a significant amount of regulatory lag?
It would.
So when you look at balance on the banding, is that increased risk for investors or decreased risk for investors, looking at both the upper and lower side?
I would say it's not congruent. So you have protection for one party and not protection for the other party. And the choice that the company makes if they under earn is a false choice, because if you file with the historical rate year, test year, you're guaranteed to earn even less than what you would using the MYRP.
That's all my redirect.
All right. Mr.
Um,
Drews?
Oh, I'm sorry.
Could I ask a brief follow-up question on that question, Commissioner?
It's not usually allowed.
Then I won't. Thank you.
All right.
We would ask that the exhibits, the direct exhibits, all 9 of them be admitted into evidence.
All right. That motion is allowed without objection.
I would move exhibits 1 through 11 into evidence, and I will remove the word proposed when I
Submit them.
submit them.
Check. And that motion is allowed.
Thank you very much.
All right. And Mr. DeSantis will be back.
Can't wait.
I believe. Okay. Does the company, I believe the company has some items to move in.
We did move for admission of the exhibits of Mr. DeSantis.
You did, but
What
I
am I
am
missing?
referring to Mr. Spanos. Is he not on direct?
We and the public staff, I think. Well, maybe we don't. No. I'll tend to my own here. Yes, thank you. We appreciate the commission excusing Mr. Spanos from having to appear at the proceeding. And we would request that his testimony be admitted into evidence as if given orally from the stand in the room.
And that motion will be allowed. I was checking to see he had no exhibits.
I apologize. I have that in some notes that are not.
I have an appendix A, I think. That's it.
I believe he did have some exhibits, but I apologize. I will need to look that up if I need to specify. Appendix A.
Yeah, no exhibits, just.
No exhibits, just an Appendix A. That's
All
right.
right, and that will be received.
Thank you very much.
All right. Does the company want to move the application as a separate item?
Yes.
Right. So the application for rate increase, adjustment of rates and charges will be received as evidence in the case.
Yes, thank you. And we'll have a number of other items, including the application. Is now the appropriate time to do that, or?
A number of other items, what?
Well, the application, the responses to customer reports, there are a number of items that we'd like to move into evidence if you're.
All right, in terms of your primary case, prima facie case, I'd say we'll receive them now.
Okay. I'll ask you to give me a minute to pull them up, and I apologize. If I could have just a minute to get to my list.
I can come back to you, Ms. Sanford. I've
You know,
caught you
if-
off
if
guard.
you would, I would appreciate it. And I have a list that is written out, but we sort of got here before I realized we were. If you would do that, I will go very speedily through the list.
No problem. We can come back to it. So, you have rested your primary case and, cases with public staff.
Thank you. Before we begin with our first witness, I'd like to note a couple things. Number one, Public Staff Attorney William Grantmeyer has joined us at council table. The second issue is that I would like to be heard on the record on a matter related to the late filed exhibit that was requested yesterday when Mr. Gerhart was on the stand. I believe that request was for an exhibit showing the company's 2022 actual expenses from the categories from which the public staff made an adjustment to remove the cager. And that information that will be provided in response will, we believe, be new information we haven't had the opportunity to audit. Earlier today, I sent an email to commission staff and copied the party requesting clarification of several issues that were related to the late filed exhibit. In addition to that, the public staff would like to request leave to elicit additional testimony from the panel of public staff witnesses Boswell, Hinton, Zhang, and Junis regarding the commission's request for a late filed exhibit.
All right, is there any objection?
I haven't had a chance, I've been occupied up here to look at the request that Ms. Yost sent out earlier. So I might need, a minute before I'm ready to respond on that. But I do think if they're going to provide additional testimony, we would want to know what that is and have a chance to address it, certainly address it in rebuttal, so that we keep the right order for the party with the burden of proof.
All right, we're not at that stage where that panel's up yet, so you'll have a chance to discuss that. And until I hear from you again, it sounds rather reasonable, but we'll see.
And I'm sorry, one more thing. I guess I should ask if that additional testimony is going to be written so that we could get a copy of it in writing before it's presented. And that way have a chance to really review it.
Yeah, we would propose to present that orally on the stand.
I assume that was the request to begin with.
Okay.
So, but you can cover what the topics are at the next break or the next opportunity you have. We won't reach that panel yet.
Okay, and we'll report back to the commission on what we discuss.
Uh-huh.
Thank you.
All right.
Thank you. With that, the public staff calls Jay Lucas.
Mr. Lucas, replace your left hand on the Bible and raise your right. Do you sincerely and solemnly swear that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth? So help you God.
Yes.
All right, Ms. Yost.
Thank you. Please state your name, business address, and present position for the record.
My name is Jay Lucas. My business address is 430 North Salisbury Street in Raleigh. I am currently the manager of electric operations and planning in the public staff's energy division.
On December 2nd, 2022, did you prepare and cause to be filed in this docket testimony consisting of 5 pages, including cover sheet, Appendix A, and 3 exhibits?
Yes.
Do you have any corrections to that testimony?
No.
If you were asked the same questions today, would your answers be the same?
Yes.
I move that Mr. Lucas's pre-filed testimony consisting of 5 pages be copied into the record as if given orally from the stand, and that his exhibits be identified as marked when they were filed.
That motion will be allowed, and Mr. Lucas's pre-filed direct testimony will be received and treated as if given orally from the witness stand. And his Appendix A will also be received. His exhibits 1, 2, and 3 will be identified as they were marked.
Thank you. Mr. Lucas, have you prepared a summary of your testimony?
Yes.
And would you please provide it?
Yes.
And just in anticipation, I've reviewed this summary. There is one phrase in here which is an additional reason for a disallowance of certain costs that does not appear in his filed testimony, and I would object to that being in the summary. That is the line where he says, due to problems with Aqua's internal staffing, initial consultant fees, those are all originally stated. And then he says, and the cost of obtaining an easement. That is an issue that was not raised in his pre-filed testimony, and therefore I believe it should be struck from the summary.
The public staff doesn't have any objection to that being struck.
All right, without objection, we will strike that from the summary.
Okay.
Are you clear on that?
Yeah, just read everything but that.
Thank you.
The purpose of my testimony is to present background and recommendations on Aqua's plant and service. Aqua had a total per books plant and service of approximately 297 million, which it pro forma adjusted to approximately $317 million. I recommend one adjustment to Aqua's plant and service for its Wakefield iron and manganese removal project for wells 6 and 8. The commission approved a cost of $370,000 to $395,000 for this project, but the final cost more than doubled to $857,797 due to problems with Aqua's internal staffing, initial consulting fees, and problems with obtaining an easement. Aqua originally planned to combine wells 6 and 8 and build one treatment system, which required obtaining the easement. Aqua contracted with an initial project consultant before obtaining the easement, which created unnecessary costs and delays. After encountering difficulty in obtaining the easement, Aqua proceeded with designing 2 separate treatment systems. However, the company went back to the original plan after it obtained the easement. In response to a public staff data request, Aqua stated the company believed the initial consultant provided unsatisfactory work and hired a second consultant to design the project. Aqua did not seek reimbursements for its payment to the initial consultant. The foregoing problems delayed the project by more than 5 years. I recommend that the commission disallow 25% or $214,449 of the project's costs because of Aqua's imprudent management. This completes my summary.
Just for the record, the public staff agrees that the words and the cost of obtaining an easement can be stricken from Mr. Lucas's summary. All right, Mr. Lucas is available for cross-examination.
Okay. I first want to ask you some about the utility plant and service numbers. Am I correct in understanding that you came up with the plant and service dollar amounts and recommended that over to the accounting staff for the public staff?
In my testimony, I'm just quoting what was in the company's application.
Okay. And when I read the testimony of witnesses Fiesel and Boswell, it indicated that they received the plant and service numbers from you. Is that correct? You don't
I
know?
can't remember that part of their testimony.
Okay. So when you reviewed Aqua's plant and service numbers, did you decide which ones should be allowed into the base year?
No, like I said previously, I've taken these numbers exactly from Aqua's application.
Okay. And in your Lucas Table 1 on page 3, you have a per books amount in the second column, right?
Yes,
Total per books. What date is that? Does that reflect?
that's the initial application that Aqua filed. Aqua may have had some updates. I can't remember exactly what
Is
the day of those updates were.
the bottom total of 296 million some dollars, is that the 2021 test year amount, or is that updated through August 31st, 2022, or some other date?
That was the per books as filed, and it was updated by Aqua.
Okay.
I mean, it was adjusted by Aqua.
So as the as filed number, would that be the calendar year 2021, the test year? If you're
I
not
believe some of
sure,
that pro forma adjustment does include some post-test year additions.
yeah, I'm talking about the column that just says total per books.
Oh, that was the initial test year, yes.
Okay, so 2021. So the column entitled pro forma adjustment, is that column of numbers what you saw in the company's filing?
Yes.
Okay. I'm going to switch here to the disallowance on Wakefield that you recommend. And just as a reminder for people, Wakefield Estates has a water system that's owned and operated by Aqua, right?
That's correct.
And they had some significant manganese and iron problems with that water?
That's correct.
Okay. And so a solution that the company and I believe the public staff both agreed upon was to install some filtration to address that manganese and iron problem.
That's correct.
Okay. And that at one point, I believe it was in 2016, you can correct me if I'm wrong on that, went before the commission and staff conference as part of the water sewer improvement charge projected to for approval if the project was completed.
Yeah, I can't remember if it was at staff conference, but it was in a public staff's proposed order that became part of the commission's order.
So everybody was on board that this was a secondary MCL problem that needed to be addressed with filtration.
That's correct.
Okay. And you have recommended $214,000 some dollars be disallowed as imprudent. Is that right?
That's correct.
Okay. How do you define imprudence?
Company not managing the project correctly.
And is that definition based on what we know now in hindsight, or rather what was reasonably known or should have been known at the time the company made its decisions?
It's information the company should have known when it made its decisions.
Okay. Would you agree that prudent management does not require perfection?
Well, nothing's perfect. So yeah, it doesn't require perfection, but I think the company erred in a few areas where it should not have.
Imprudence is a reasonableness test, right?
That's correct.
Okay.
And I think the company was unreasonable in some of its actions.
Now, in terms of imprudence disallowances as applied by this commission, would you agree it requires two elements? First, at least two elements. First, a showing of an imprudent act or decision or omission. And second, that the cost being disallowed were directly caused by that imprudent act or decision or omission.
I'm sorry, say the second part again?
That the cost recommended for disallowance were caused by the imprudent act.
That's correct.
Okay. So on page 4 of your pre-filed testimony, you indicate that Aqua incurred excessive, and I believe you mean unreasonable or imprudent cost due to problems with internal staffing and with an engineering consultant.
And also it proceeded with the project before it acquired an easement that was necessary to make the project successful.
Yes, sir. And we're going to take these one by one. On the staffing issue, maybe walk through the chronology here. You've read Mr. Milton's testimony on this,
That's correct.
and you've read the discovery responses of the public staff. I mean, excuse me, that's as bad as saying Carolina Water. You've read the discovery responses of Aqua to the public staff.
That's correct.
Okay. So do you understand from the testimony and the company responses to data request 118 that Aqua assigned this Wakefield filtration project to an engineer named, that was on their staff named Ms. Ambika Devi, if I've pronounced that right?
That's correct.
Okay. And she was supervised by the engineering manager at the time, Mr. Pulius?
That's correct.
Okay. Now, the engineering manager, Mr. Pulius, left Aqua in May of 2017, roughly?
Let me check. I've got Mr. Melton's testimony here. Yeah, that's correct, May of 2017.
But even though he left, the engineer, Ms. Ambika Devi, continued to attempt to negotiate an easement with the Bayleaf Baptist Church.
That's correct.
Okay. And the purpose of this easement was to allow interconnection of wells 6 and 8. Is that right?
That's correct.
So if wells 6 and 8 were interconnected, there could be just one filtering system at Wakefield. Is that right?
That's correct.
And if they were not interconnected, you would need a separate filter on each of those wells, right?
That's correct.
Okay. So the point of getting the easement was to lower the cost of having 2 filtration systems and get it down to just one filtration system.
That's correct.
Okay. Now, if you, back to the staffing chronology, you understand Mr. Melton, Michael Melton, was named engineering manager for Aqua around January of 2018.
I'm
You-
sure it's in here somewhere.
Will you accept it, subject to
Accept it,
check?
subject to
Okay.
check, yeah.
Just to move this along. And Ms. Ambika Devi left employment at Aqua in April of 2018?
That's correct.
Okay. Are you alleging that the departure of either Ms. Ambika Devi or Mr. Pulius were caused by imprudent management acts at Aqua?
I don't know what was happening. This project was supposed to be completed with what Aqua filed with the commission. It was supposed to be completed in September of 2016. 2 people working on it departed much later. I don't know what the problems were. But Aqua North Carolina doesn't work in a vacuum. It's got a parent company. It was getting notices of deficiency from DEQ because of these iron and manganese problems. It should have sought some help somewhere. If these 2 people either were not able to do the work or departed the company, it was the company's responsibility to correct a problem in an efficient manner.
So, do you think their departures were the product of any imprudent management? Do you have any evidence to that?
I don't have any evidence about
Okay.
how Aqua managed its
Okay.
human resources.
And are you saying there was imprudence because the new engineering manager was not able to get replacement hires until June of 2018?
I'm not really drilling into Aqua's human resources management, but it did have a responsibility to correct a problem with the iron and manganese. Like I said, it had notices of deficiency. It had an engineer working on the project, but what happened, it started to incur costs. It hired an engineer. It hired a company to design the treatment system. Before it even got the easement, it started incurring those costs without an easement in hand. And that's part of my recommendation, and that's part of the problem.
I understand, and you have several separate reasons you offer in your testimony, and right now I'm focusing on the internal staffing reason you have
Okay.
proposed, not the one about doing the easement and the engineering design in parallel.
Well, these people were responsible for trying to get the easement,
Right, but if they weren't there, then,
but they were there in 2016
Mhm.
When the project was supposed to be completed.
And do you understand from getting back to the easement, since that seems to be the focus here, that the company initially was led to believe by the Bailey Baptist Church that they were open to negotiating an easement.
That's pretty weak. That's a pretty weak factor to use and start to expend funds for hiring an engineer and starting to buy equipment.
So you're familiar with Gantt charts engineers use, right?
Yes.
Okay, so often where you can, you try to work parallel paths for required tasks so that it's more efficient than doing everything in sequence and taking a lot longer to complete a project.
Yes, but in this case, Aqua took too much risk and incurring costs before it had the easement in hand. The easement was necessary to complete Aqua's plan.
Are you saying that it was risky to believe what the church had initially told them about being open to negotiating an easement?
Well, it's a verbal communication starting to negotiate an easement. That was not enough basis to start incurring engineering costs or incurring equipment purchase costs.
Okay. So getting back to staffing, after Ms. Mbika Devi had left in April 2018, and it took Mr. Melton until June of 2018 to hire new engineers. Was that time frame, was it imprudent that it took them that long to find engineers who were qualified to join the company and handle these kind of projects?
I don't know the company's internal workings. I mean, it could have approached its parent company. It was starting to receive notices of violation. It had known about the problem, I think in 2014, known about the iron and manganese problem.
So
I'm not saying the timing of hiring new engineers imprudent, but somehow the company should have gotten some help somehow.
sure, and so they do have a parent company, Essential Utilities, up in Pennsylvania, right?
I think they're in Pennsylvania, yes.
Yeah, and the parent company has other operating subsidiaries in other states.
That's correct.
So are they supposed to tell an engineer from one of their operating subsidiaries in another state who may or may not be licensed in North Carolina that they need to drop their job responsibilities in that other state and come down to North Carolina to take care of this problem?
Well, first of all, I don't think that engineer has to be a licensed professional engineer to do some of this work. But Aqua has the responsibility. I'm not saying this engineer should drop whatever they're working on, but certainly receiving notices of violation, notices of deficiency is a problem. But at least the parent company should have taken notice and realized the project was many months behind schedule and taken some action to correct it.
So once Mr. Melton had, again, going back to the company testimony, once he had trained an engineer, he did put a new engineer on, Mr. Norris, on the Wakefield project in late 2018, right?
Yes, and also, and this is, we're on page 6 of Mr. Melton's testimony, right around line 4. That's also when Aqua obtained an attorney to help pursue the easement. And this is 2018. The project was supposed to be completed in 2016. Obtaining the easement is an engineering issue, but it's also a legal issue. And that was a delay, an unnecessary delay to seek legal help over a year and a half after the project was supposed to be complete.
Are you saying us attorneys are unnecessary?
No, it should have been, it was very necessary and should have been obtained sooner.
So do you understand that the new church leadership that had come in had taken a different tact and was willing to proceed with negotiations on the easement more productively than the prior church leadership?
Yeah, that's also later on page 6 of Mr. Melton's testimony.
And that they were asking for a lot more money than Aqua normally pays for an easement?
That's in Mr. Melton's testimony. It's
Okay.
written in his testimony.
Right, and so the company decided to go out and get an appraisal to make sure that it was not an unreasonable request by the church?
Yeah, that's on page 6, line 17.
Yeah, and that took some time too, right?
I don't know how long that took.
Okay. So in terms of, one of the things you suggest here is that Aqua should have sought compensation from the original engineering design firm because their work was not completed. It wasn't satisfactory to Aqua, and Aqua went out and hired a new firm. Is that right?
That's correct.
Okay. Assuming Aqua is correct that the original firm work was deficient or at least delayed, do you have the legal experience to say Aqua could have prevailed in a lawsuit against them on that?
But first of all, it wasn't just delayed, it was also unsatisfactory. And also, Aqua doesn't have to file a lawsuit to try to get some of its money back. I mean, some of its staff could have called Freeze and Nichols, the engineering consultant, and said, hey, this is deficient, here's why, you owe some compensation. A later step would have been Aqua's attorney contacting Freeze and Nichols' attorney to say, hey, you owe us compensation. Filing a lawsuit is not the first step.
So do you understand the invoices that were paid up to the date were basically hourly billings by Freeze and Nickel for the hours they had put in?
I don't have all the invoices in front of me.
Okay, well, we'll just move on from that. So you think if Aqua had gone to Freeze and Nichols, then Freeze and Nichols, the engineering design firm, would have said, sure, we'll give you your $70,000 back, or whatever the amount was.
I don't know what would have happened, but Aqua should have tried.
And they were imprudent for just not telling them, give us that money back?
Or some level of money.
Now, if Aqua had needed, are you saying it would have been successful if they had made that request?
No, but it should have tried.
So in terms of causation for your disallowance, if you don't know if it is successful or not, how do you know that those are costs that actually should be disallowed?
Well, Aqua didn't even try to get it back.
But
testimony, it should have at least tried.
if they had tried and been unsuccessful, then they wouldn't have gotten any money back.
Well, that's hypothetical. I can't
Right,
tell you right in one way or another.
right. There's no causation to your disallowance number, is it?
Well, there is causation because Aqua says the design was unsatisfactory.
Do you understand from Mr. Milton's testimony that the second engineering design firm, Wooten, was directed to use as much of the Freeze and Nickel work product as they could when they finished up the design?
That's correct, but we don't know how much.
And to the extent they did, then there was some value for that Freeze and Nickel work product, right?
It's hard to set a value. For one thing, one engineering firm cannot sign and seal another firm's work. It could use some for initial work, but all the responsibility and every bit of the risk was placed on Wooten Company once it took over the project as an engineer.
Mm-hmm. That's all my questions. Thanks.
Redirect.
Thank you. Mr. Lucas, Mr. Drew suggested that there was no causation to your disallowance. Did you hear him?
He said that, yes.
All right. One of the, I guess, sources of imprudence or unreasonable omissions that you say the company made was, their failure to adequately staff the project, and that resulted in a pretty significant delay in completing it, correct?
That's correct, and that's not really the fault of the customers.
Would you say that a prudent company would have a contingency plan for completing projects if an employee that was directly responsible leaves?
That's correct.
And so what's one, I guess, monetary result in the failure to adequately staff the project and to complete the project on time?
Well, it delayed the project, and that caused the company to increase the allowance for funds used during construction, or the AFUDC. It started incurring a bunch of AFUDC costs. I mean, the project was ultimately delayed by about 5 years with a fair amount of AFUDC that should not have been the responsibility of the customers.
All right. And I'd like you to take a look at what is identified as Lucas proposed direct exhibit number 1.
You mean redirect exhibit?
I'm sorry, redirect exhibit number 1. And I would request that that be identified as Lucas redirect exhibit 1. I think I have that correct. Please correct me if I'm not using the proper terminology.
Repeat the,
Yes, Lucas redirect exhibit number 1.
all right, that would be so identified.
Thank you. Mr. Lucas, can you tell us what this exhibit is?
This is a summary of the Wakefield transactional listing that Aqua prepared.
All right. And are the 2 first pages of that document a pivot table that summarizes the detailed transaction listing of the Wakefield W-218 filter project?
That's correct.
And am I correct in describing pages 3 through 11 as a printout of the detailed transaction listing that was provided in response to public staff data request 67?
That's correct.
So starting at the top of page 1, does it show a summary? I'm sorry, does the summary show that there were nearly $60,000 of AFUDC incurred?
That's correct.
And I think, could you again explain what happens to the amount of AFUDC as the timeline of a project progresses?
So the AFUDC is what the company retains this allowance for funds used during construction. When Aqua started this project, it started incurring some costs that it can essentially gain interest on until it gets reimbursed from rates.
All right. And we talked about, or Mr. Drews asked you some questions about your assertion that the work product, or that Aqua paid for work product produced by Freeze and Nichols, which Aqua believed was inadequate or somehow lacking. Is that correct?
That's correct. Those are Aqua's words, that it was inadequate.
And has Mr. Melton represented the Aqua checked or required delivery of work product before it cut a check to Freeze and Nichols?
No, it made some payments along the way without, as far as I can tell from his testimony, without checking the quality of the work.
Do you believe that paying invoices of $70,000 without checking the work that the payment is for is reasonable?
No, it's not.
All right. Now, Mr. Drews also addressed the engineering costs and Mr. Melton's rebuttal testimony. Can you tell us how much Freeze and Nichols estimated in engineering costs?
Initially estimated $26,000.
And can you tell us what happened as the project progressed to the cost of the project?
A few things happened. Aqua started paying Freeze and Nichols, and it also incurred costs for the treatment system from a company called Adage before it got the easement. It had some difficulty getting the easement. It also had problems getting the work Freeze and Nichols.
Just give me a moment, please. All right, those are all my questions. Thank you.
Questions from the commission? Commissioner Kleinfelder?
Mr. Lucas, I want to ask you a question or two about the table 2 on page 5 of your testimony, so you might want to have that in front of you. You've proposed adjustments in this item that we've been hearing about, the project to deal with iron and manganese in wells 6 and 8. Your adjustment proposed is about $214,500 in total. And I see your chart that you've applied some percentage reductions on several account items in arriving at that number. And I understand the chart. You referred in some of your answers to Mr. Drew's questions to the rebuttal testimony provided by Mr. Melton, so I'm going to refer to it too.
Okay.
Mr. Melton takes you to task in his rebuttal testimony. He says the public staff hasn't provided any basis for the quantification of the amount of the proposed disallowance. And of course, in addition to the other requirements for finding an expenditure imprudent, we also must be able to quantify the amount of the loss occasioned by the imprudence. So I want to focus on that topic.
Okay.
If I look at the preliminary opinion from the engineer about the total cost of the project, that's exhibit to Mr. Melton's rebuttal testimony, the Freeze F&N estimated that the total project cost would be about $642,000.
That's correct.
And it's just, to me, really, it's an interesting mathematics that the difference between the actual final cost and the preliminary opinion of total cost given by F&I was about $215,000 is the difference between the actual final cost. And then I look at your table 2, and the amount of the proposed disallowance is almost $215,000. I have to ask you if that's just a pure coincidence, or is there any correlation between that difference between the original engineering estimate and the final cost and the amount of the proposed disallowance?
No, because I did not have that engineering estimate when I had my direct testimony file.
You did not use or rely on that preliminary engineering testament in compiling Lucas Table 2.
And to be clear, you're looking at Melton Exhibit 3, Melton Rebuttal Exhibit number 3.
Yes.
I did not have that information when I filed my direct testimony.
That answers my question. You did not have access to that information when you made the proposed disallowance.
That's correct.
Okay, so what was the basis for the percentage factors you used on Lucas Table 2? How did you arrive at those percentages rather than any other percentage?
Like my 25% recommendation?
Well, the 40% for category GL account 304.
I understand.
Yeah.
This project, these 3 items, structures and improvements, treatment equipment, and supply mains were all necessary to complete the project.
Right.
We looked at pieces of the project, like structures improvements. This treatment equipment had to go inside of a building that was built by a contractor, Tyndall Builders. Second one is water treatment equipment. The company was Adage that supplied the treatment equipment. We had to do an approximation of what level of responsibility. The last one, the only 10% was supply mains. That was to connect the 2 wells. That was a smaller piece. We did an approximation of these 3 categories and about what percent of my $214 recommendation would fall into each category.
Well, how did you do that approximation? For example, in the first item, how did you determine that the building cost $85,799 more than it should have cost?
Uh, In response to public staff data request 92-4A, Aqua did provide us with some information about some of the costs to Adage Technologies, $285,000. Another cost to Kevin Tilder Builders for $277,000. It's just a rough approximation how to distribute, and really the net effect to customers really it isn't based on that percentage. We really didn't have a lot of information. Aqua did not respond well to our data requests. Most of this information we're talking about today, I got after I filed my direct testimony.
Okay. Okay, thank you. That's helpful. Is the data request that you mentioned 92, I wrote it down as 92-4A. Did I write down the right
That's correct.
designation? Is that anywhere in the record?
Let me check it. Yes, it is. It's hold on just a minute.
If you could
please.
give me a reference, I don't need to walk you through it now. I can read it on my own, but if you can just give me the reference.
Yes, it's in my direct testimony, Lucas Exhibit 3.
It's Exhibit 3. That is
correct.
the data request you're referring to?
Yeah,
Okay.
I put that response
Okay.
in my data request.
All right. Last question on this table, and I'll leave you alone then.
Sure.
Can you tell me how much of the proposed disallowance is your calculation of excessive AFUDC?
I don't have that exact amount.
Did you make such a calculation?
No, I did not.
It's just one of the factors you considered in arriving at your percentage estimates in that third column.
That's correct.
But you didn't do a separate calculation of how much additional AFUDC you think was occasioned by the delays in getting the project underway and under construction.
That's correct, because we didn't want to disallow all of the AFUDC. Some of the later ones, when they had the Wooten engineering firm, and some of the later costs by Adage and Tyndall Builders was legitimate AFUDC. It's hard to draw the line exactly what date we should start allowing AFUDC, and anything before that date, we would not allow AFUDC. It was hard to determine that specific date because we don't know exactly the chronology of all the events. I didn't have that information. I mean, a lot of the dates we're talking about were from Melton's rebuttal testimony. Of course, I didn't have that when I.
And again, you did not have that information when you prepared your table and your proposed disallowance.
That's correct.
I'll leave you alone. Thank you.
Commissioner Duffy?
I have one follow-up with respect to that last question with respect to the AFUDC. So you made the claim that it should not have taken 5 years. There were 5 years of AFUDC. How long would a properly managed project, in your opinion, take? How many years?
It should have only taken 6 months, and that's Aqua's number. When it filed a request in January of 2016, it told the commission it would take until September of 2016. So for the approval in March to September was about 6 months. That was Aqua's estimate.
Okay, thank you.
Mr. Lucas, on your page 5 in your direct testimony, lines 1 through 4, I believe it is, you spell out there the 3 areas of the disallowance, the charges from the original engineer's work, the AFUDC, and the charges, Aqua charges such as capitalized time and allocations, right? Do you have, I understood from your answer to Commissioner Kleinfeld that you didn't have an exact number that you tied to AFUDC. Do you have exact numbers for the other 2? Could you provide? Did you do those calculations?
Wait a second, I'm reading that testimony right now. I don't, because we don't know exactly how much of the early engineering work by Freeze and Nichols that Wooten was able to use. So we can't say, we could look at Wooten's costs, but certainly all that greatly exceeded what Freeze and Nichols thought the original engineering costs would be.
All right. And on the third one?
Okay, capitalized time and allocations. The capitalized time is Aqua's internal costs, internal labor costs that it would apply AFUDC to. And since looks like there were problems early on with some of the earlier engineers, but then Aqua was able to apply after Mr. Melton came on board, apply effective engineering work and complete the project. Some of most of that time onward, I think it was legitimate AFUDC, but I can't draw the line exactly because it's such a time-driven cost. I can't draw the line exactly what falls in or out of the public staff's recommended disallowance.
And so tell me again, or bring me back to, how did you make your approximations?
You're talking about each percentage in my Lucas table too?
Yes.
It's a rough approximation of the true capital cost to build a project. I mean, these are physical assets, so roughly 40% for the structures, the building, and connecting the treatment system, and also 50% for the treatment system itself, which was the highest capital cost.
And so your adjustment was that percentage to approximate these three areas of disallowance?
Yes.
All right, thank you. Any other questions? Questions on commission's questions, starting with,
Sorry, but I always do.
it's okay.
So I believe you just said in response to Commissioner Duffley that this should have been completed within 6 months of when it was approved green-lighted by the commission order. Is that right?
Yeah, that was Aqua's timeline.
Right, and that would have been in 2016.
That's correct.
Right, but there was no easement from the church at that time, was there?
And Aqua knew that.
Okay, so that meant if they had proceeded on the schedule, completing within 6 months, they would have installed 2 filters instead of 1 because they wouldn't have had an easement for an interconnection of the wells.
Well, I guess Aqua might have built, I don't know exactly what its actions were, but it might have thought it could obtain the easement sooner, and built 1 system.
Well, you saw their testimony data responses that they were trying to obtain an easement sooner, and the church was not making a decision on it. So that was because of the church's indecision, they could not obtain an easement sooner, right?
I don't know if it's the church's indecision or some of Aqua's actions. I don't know exactly what Aqua said or how Aqua managed obtaining the easement.
So if you don't know, you're not sure that Aqua was at fault there, right?
Well, it's not necessarily obtaining the easement itself. The premise of that disallowance is the fact that Aqua started incurring costs that it should not have without an easement in hand.
So I want to go
And
back.
let me finish it. This wasn't just a 6-month delay. This was a 5-year, 6-month delay.
But you had testified that it should have been completed in 6 months. And if they did not have an interconnection to wells 6 and 8 because they didn't have an easement, then to complete on that timeline, they would have had to put in 2 separate filters, 1 for each well, right?
If it could not get the easement, it would have had to, yes.
Yeah. So that brings me to something you discussed with the commission, Milton Rebuttal Exhibit 3, which is the opinion of probable construction cost. Now that $642,000 estimate of construction cost was for 1 filter system, not 2, wasn't it?
That's correct.
Okay, so if they had gone and completed this in 6 months without the easement, they would have had to essentially double this $642,000 cost, wouldn't
Not
they?
at all. There's a lot of basic costs in here. And also, Freeze and Nichols puts in a 25% contingency, an extremely high contingency. And I also want to note, Aqua initially estimated the maximum cost is a little bit under $400,000. And that's what it told the commission. That's what got in the commission's order. 2 weeks after the commission's order, Freeze and Nichols does an estimate. and increase cost by $100,000, put up to $513,000, and put on a 25% contingency, which was very generous. You'll note that that total comes out to $641,000. That's still less than what the public staff's recommended allowance is, and this is Aqua's engineer that developed this estimate.
So the ad edge system cost down on WF-9 in column 1, that by itself, that equipment is 182,000, which would have to be doubled if you were going to put in a second filter system, right?
No, I can't say, but I mean, this is for one larger system. It might have built two smaller systems for less than that.
That's all my questions.
All right, public staff.
Thank you. So you received a few questions from the commission about how you came up with your recommended adjustment, correct?
That's correct.
And is it fair to say that you considered the reasonable costs of the engineering work that was done? That's Tyndall, Adage, and Wooten?
Well, it's engineering and construction and equipment.
And are those costs reflected on the Lucas redirect exhibit number 1?
Yes.
And just to clarify, you also got some questions about the Lucas Table 2 on page 5 of your testimony, and I'll
That's
just give a
correct.
moment to get there. So the percentage in the second to last column on the right, am I correct that that is the allocation of the total project costs to plan accounts?
This would be all plant service. I mean, I guess you call it the middle column spend, that $857,000. I mean, that's what Aqua spent, and that's what I recommend should be disallowed to some extent, or by 25%.
Okay, but the percentage shown in that column is actually the percentage of the total project cost that was allocated to those plan accounts shown on the far left hand.
That's correct.
Those are all my questions. But I would like to move Mr. Lucas's redirect exhibit number 1 into the record, please.
Number 1, his redirect exhibit 1, Lucas redirect exhibit 1 will be received into evidence at this time. And is 1, 2, and 3?
Those ones as well, please.
All right.
Thank you.
They will also be received into evidence at this time. All right, Mr. Lucas, you may be excused.
The public staff calls Mike Franklin.
Place your left hand. Do you sincerely and solemnly swear that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth, so help you God?
I do.
All right, please be seated.
Mr. Franklin, could you please state your name, business address, and present position for the record?
Yeah, my name is D. Michael Franklin. My position is I'm a public utilities engineer in the public staff, water, sewer, and telephone division. My business address is 430 North Salisbury Street, Raleigh, 27603.
On December 2nd, 2022, did you prepare and cause to be filed in this docket testimony consisting of 13 pages, including cover sheet, Appendix A, and 3 exhibits?
I did.
And on December 13, did you prepare and cause to be filed public staff corrected Franklin Exhibit 2?
That's correct.
Do you have any other corrections to your testimony or exhibits?
I do not.
And if you were asked the same questions today, would your answers be the same?
Yes.
I move that Mr. Franklin's pre-filed testimony consisting of 13 pages be copied into the record as if given orally from the stand, and that his exhibits, including his corrected Exhibit 2, be identified as marked when they were filed.
All right, does corrected Exhibit 2 replace the initial?
It does.
All right. That motion will be allowed. The direct testimony will be received and treated as given orally from the stand. And exhibits 1, 2, and 3 are identified as when pre-filed.
Thank you. Mr. Franklin, did you prepare a summary of your testimony?
I did.
Could you please read it?
Yeah, the purpose of my testimony filed on December 2nd, 2022 is to provide the commission with the results of my investigation into specific areas of the application filed on June 30th, 2022 by Aqua North Carolina Incorporated in docket number W-218 sub 573 for a general increase in rates and approval of a water and sewer investment plan. My area of investigation, this proceeding has been the review of the records and expenses for purchased power, sludge removal, purchased water, purchased sewer, meter reading, and contract services other in coordination with the Public Staff Accounting Division. I provided the Public Staff Accounting Division with recommendations for adjustments to purchase power, sludge removal, purchase water, and purchase sewer as detailed in my direct testimony. This concludes my summary.
Thank you. Mr. Franklin's available for cross-examination.
Thank you. Aqua has no questions for Mr. Franklin.
In that case, I would
Oh,
move that.
Any questions from the commission?
Oh, sorry.
I have at least one here. Just a second. You guys are moving along. I like that. Mr. Franklin, regarding the public staff's downward adjustments to purchase sewer water expense related to the 3 systems that were purchasing water from Union, from Union and Johnson counties.
In Aqua America.
Right. And Aqua objected because they said the actual invoices were available. Have you had a chance to review those invoices?
I have not.
All right. I had another question. So on the purchase sewer, correct me if I'm mischaracterizing or misread your testimony, but I read it to say you were concluding that since your own calculations had been less than the company's, the company had overstated its sewer expense. Is that right?
Right.
And given that you think it was overstated expense, but you didn't make an adjustment, is that read it?
That's right.
Why no adjustment in that instance?
Because their response to data request 22 provided a spreadsheet, which is what I used for my analysis, and those totals were less than what they requested in their application.
All right, thank you. Are there questions on commission's question?
No questions.
No questions.
All right. Now, Ms. Yes.
All right. At this point, I would like to move that public staff Franklin Exhibits 1 and 3 and public staff corrected Franklin Exhibit 2 be entered into the record.
That motion is allowed. The evidence is received. Mr. Franklin, you may be excused.
Would you like me to call the next witness? Public staff calls Sashi Bhatta.
Okay. That's so quick. You would place your left hand in the Bible, raise your right. Do you sincerely and solemnly swear that the testimony you're about to give will be the truth, the whole truth, and nothing but the truth, so help you God? All right, please be seated.
Good afternoon, Ms. Bhatta. Could you please state your name, business address, and present position for the record?
My name is Sashi M. Bhatta. I'm a public utilities engineer at the Water, Wastewater, and Telephone Division of the Public Staff. And my business address is 430 North Salisbury Street, Raleigh, North Carolina, which is also known as the Doss Building.
On December 2nd, 2022, did you prepare and cause to be filed in this docket testimony consisting of 26 pages, including the cover sheet, Appendix A, and one exhibit?
That is correct.
Do you have any corrections to your testimony?
No, I do not.
If you were asked the same questions today, would your answers be the same?
Yes.
I move that Ms. Bada's pre-filed testimony consisting of 26 pages be copied into the record as if given orally from the stand, and that her exhibits be identified as marked when they were filed.
All right, that motion is allowed.
Ms. Bada, have you prepared a summary of your testimony?
Yes, I have.
Would you please read it?
The purpose of my testimony is to present my review of Aqua's customer service record and findings from the review of the company's chemicals and contract services for laboratory testing expenses. I reviewed the company's testing costs by reviewing the testing schedule, which is based on DEQ's compliance testing requirements, the company's process testing plan, and testing invoices provided by the company. Based on my review, Aqua's proposed pro forma testing expense is reasonable. Therefore, the public staff agrees with company's requested pro forma testing expense. I reviewed Aqua's chemical expense for both its water and wastewater operations by reviewing the chemicals used during the test year, chemical invoices, and the chemical supplier statements for verification of chemical prices and charges. Based on my review, the company's proposed pro forma chemicals expense is reasonable. Therefore, the public staff agrees with the company's requested pro forma chemical expense. I investigated Aqua's customer service record by reviewing the consumer statements of position filed in docket number W-218 sub 573 CS, complaint logs maintained by the public staff's consumer services division, the company's customer complaint log, emails received by the company specifically related to discolored water, and the testimony provided by customers at 4 public witness hearings. Based on my investigation, the public staff believes that the company's approach to handling customer complaints is satisfactory. That completes my summary.
Thank you. Ms. Bada is available for cross-examination.
Good afternoon, Ms. Bada.
Good afternoon.
Thanks to the repeated use of phrases such as agree with and satisfactory, we are not going to have any questions of you this afternoon. We appreciate your work and your testimony.
All right, questions from the commission? All right. We'll hear.
Thank you. I move that Public Staff Bada Exhibit 1 and, that's the only one, be entered into evidence, please.
All right, it will be received. Ms. Bata, thank you. I think the company was trying to give us a hint that they like you to use words like agree, but it got you a short stay on the
circled
stand.
them in our.
So you are excused. All right. And if there's no issues today, I do plan to go to 5:30. So you can call you next week.
The public staff calls Evan Hauser.
Good afternoon, Mr. Hauser. If you place your left hand on the Bible and raise your right. Do you sincerely and solemnly swear that the testimony you'll give should be the truth, the whole truth, and nothing but the truth? So help you God.
I do.
All right, Ms. Jones.
Please state your name, business address, and present position for the record.
My name is Evan Hauser. My business address is 430 North Salisbury Street, and my position is a public utilities engineer for the water, sewer, and telephone division of the public staff.
Thank you. On December 2nd, 2022, did you prepare and cause to be filed in this docket testimony consisting of 22 pages, including the cover sheet, Appendix A, and 3 exhibits?
Yes.
Do you have any corrections to that testimony?
No.
If you were asked the same questions today, would your answers be the same?
Yes.
I move that Mr. Hauser's pre-filed testimony consisting of 22 pages be copied into the record as if given orally from the stand, and that his exhibits be identified as marked when filed.
All right. There being no objection, that motion is allowed.
Have you prepared a summary of your testimony?
I have.
Please read it.
The purpose of my testimony is to present the results of my review of Aqua's environmental compliance, including records kept by the company and the North Carolina Department of Environmental Quality, NCDEQ, and my recommendations on Aqua's water quality reporting, fuel for production, and fuel for transportation expenses. I discussed the company's approach to addressing PFOS and PFOA compound levels in drinking water as it relates to environmental compliance, as well as findings of non-compliance, which include violations, penalties, and notices of deficiency issued to Aqua by NCDEQ. I recommend that the Commission require the company to continue the same secondary water quality reporting requirements ordered in dockets number W-218 sub 363, 497, and 526, with the additional modification that the company be required to file a report regardless of whether the water and sewer investment charges, WISIC, are in effect and Aqua has an expectation of WISIC funding. I also recommend an adjustment to the company's fuel for transportation expense based on a 24-month average of fuel prices and an adjustment to the company's fuel for production expense based on a 3-year average of the company's expenses. Excuse me, the 24-month average of fuel prices. The company's fuel for transportation expense is based on a 24-month average of fuel prices. I believe I may have said based on the company's expenses. So that completes my summary.
Thank you. Mr. Hauser is available for cross-examination.
Thank you. Good afternoon, Mr. Hauser.
Good afternoon.
I had an initial question, and I want you to clarify something for me. My understanding, and I'll take your corrections, is that EPA is developing a drinking water regulation with respect to PFAS, PFOA, that they anticipate finalizing by the end of 2023. Is that correct so far?
The regulation is with respect to PFOS and PFOA specifically. And yes, they have stated that they intend to finalize it by 2023.
What is your expectation of when there will be a final rule? I think you had a different view of that.
Say again?
Did you indicate that you thought that would be later than 2023 before they get that done, or did I misread your testimony? I may have.
I did not speculate a different date
You
other
didn't?
than the EPA's.
You made some reference to the time that it took to do the lead and copper regulation,
You're talking about the compliance date.
the compliance dates. That's right.
And the
Would you,
compliance date is when the companies or the water systems are required to comply with the new rule.
I see. And so it was the compliance date that you thought would be what year?
I said that if the compliance date followed the same sort of time frame as the LCRR, that it would be 2026, assuming the EPA finalized and published their rule in the end of 2023, as they've stated their intention to do
Okay,
so.
thank you. But you don't have any disagreement with the anticipation of the rule itself issuing by the end of 2023. Is that correct?
I can't speak to whether or not the rule will or will not be completed by 2023. I don't have any additional information on
So you
that.
have-
There have been other situations where the rules have been delayed. We saw that with the LCRR. And the rule, according to EPA's information that they published in their June webinar, they did say they would have a proposed rule by fall of 2022. And to my knowledge, there is not yet a proposed rule that's available.
Okay. All right, thank you. I have no more questions.
Redirect.
I do not have any redirect.
All right, questions from the commission? Chairman.
Mr. Hauser, question about the water quality reporting that you recommend the commission direct the company to continue. How is the Aqua addressed in its rebuttal testimony that it had conferred with the public staff about or inquired of the public staff about use of these reports? And I don't remember off the top of my head, and I'm not going to take the time to find it right now. But Aqua asked public staff how it was using certain of the reports that it's obligated to file, and the public staff's response was less than satisfactory to Aqua. But can you help me understand how the public staff is using those secondary water quality reports?
So the public staff uses those reports as an opportunity to look at how the company is addressing their water quality issues. And then we're offered an opportunity to discuss that with them and then present the information to you.
So are you all, is there someone that's assigned to review those reports when they come in?
I believe Mr. Junis assigns them as he intends.
Okay, so I'm just answer my questions to the best of your ability, because I'm trying to get an understanding of how you all are using it and how often you're referring to those reports. I mean, is it your understanding that they're reviewed contemporaneously with when they're submitted to you all, or do you wait until you have a rate case or some other type of proceeding ongoing that you review a bunch of them at once?
I'm not sure. There's only been one filed since my time at the public staff.
Understood. Okay. All right, Mr. Junis, that question's going to come to you then when you're up. Have you personally been involved in a review of the one report that's come in since you've been here?
I have,
You have?
yes.
And what did that report say?
The report discussed a number of water quality complaints from customers. And it included the company's response to those complaints and the company's plan to address them, as well as discussion from public staff regarding those complaints.
Okay, and what did you do? What, if anything, did you do with the information you gained from that report?
The public staff recommended that the company look into additional options for how to address the issues.
Okay, and do you know how that recommendation was made to the company? Was it made in the context of this rate case or in some other proceeding, or was it made informally
I believe it was included in the report.
in this rate case?
No, excuse me. Sorry. I think it was included in the report.
In what do you mean included in the report?
Well, the product was our discussion.
Okay. All right. Mr. Junis, I will follow up with you on that issue during your testimony. Thank you, Mr. Hauser. I have nothing further.
Commissioner Kleinfelder.
Mr. Hauser, I promise you there's going to be a question at the end of what I'm going to say, but I have to preface it with a comment to set the context for the question. And then I'm going to let you talk, open-ended talk about the question. The comment is this: I cannot remember how many hours or even days I sat here and listened to parties go back and forth about what should have been done and what should have been known, and when it should have been done and when it should have been known about coal ash. And it was the position of the electric utilities that they really couldn't take any actions at all until regulations had been promulgated and finally adopted by the EPA, and until CAMA had been adopted and DEQ had adopted regulations, and that they really just had a free pass until the time that those regulations went into effect. And then I heard the advocates on the other side of the issue say there were things the company should have been doing, there were things the company was on notice about, there were actions the company could have been taking to get itself into a position to be ready to deal with the coal ash issue, and it was imprudent for not taking any steps at all. And now today, I've got a company that's here wanting to take some action, wanting to do something about these PFAS chemicals in advance of the final adoption of whatever MCLs the EPA is going to promulgate. And so I feel really weird about that situation. That's the comment. I feel really weird about that situation that we're in. So the question I'm going to ask you to talk about is this: we learned in the coal ash that there were things that companies could have been doing responsibly and prudently in advance of knowing the final regulations. They could have been dewatering the lagoons. They could have been characterizing the quantities of coal ash in those lagoons. They could have been doing more groundwater monitoring in advance of even knowing what the regulations were going to say. And that would have put them in a better position to move quickly, expeditiously, and cost effectively to respond to the regulations. So the takeaway I have from that experience is the question I want to ask you is, are there not some things the company could be prudently doing now with respect to the characterization of PFAS issues in its water supply sources, with respect to monitoring, with respect to establishing the necessary infrastructure to put it in place for whatever standards are ultimately adopted? Are there some no regrets actions the company can take today, even before it knows what the MCLs are going to be? And shouldn't the company prudently be proceeding with those now so that when we have the regulations, they can act quickly and cost effectively? I'll let you talk.
That's more than a compound question. So get them all down.
So I'm going to give you, unfortunately, more than a compound answer.
That's fine.
Hopefully, sorry.
I
if it
invited
runs
it, so I can't complain about getting it.
Okay, you just stop me when I run off into who knows what. So the company's structure in North Carolina is a little bit different than their structure in some of the other states that they operate. Their five largest systems account for 33% of their customers, where their median number of customers is 48. So there are 369 water systems that Aqua operates in North Carolina that have 48 or less customers in them. So they have a very fractal nature. They rely mostly on groundwater for their treatment. So in order for them to move forward and develop a holistic plan to approach any future MCL or MCLG, which is on its way, they need to know the extent of the treatment required, because they're going to need to utilize treatment, which they've talked about in their testimony. They're going to need to utilize interconnections between their systems, potentially other systems they don't own, as well as decommissioning infrastructure that they don't necessarily need to rely on. And so those are all components of a holistic plan to approach the entirety of the state of North Carolina together. And you can't do that until you know how many systems need treatment, how many customers are impacted. If the limit is lower, obviously that number is going to go up. If the limit is much higher, you can expect to see the number of locations where they're going to need a solution to go down. Does that answer your question?
Well, it helps me understand the world better, and that's always useful. But let me repeat the question again. Is there no actions the company could be taking now, though, to put themselves in a better position later to act expeditiously when we know what the MCLs will be?
I think understanding the systems which could potentially be impacted would be a start.
Characterization of the scope and the extent of the issue would be a prudent thing to know.
Yeah, and ultimately it'll be unknown exactly which systems are impacted until after the regulation exists.
Okay. So the public staff's objection right now is to the targeted spend on some particular systems to actually begin treatment in advance of knowing what the treatment levels are going to require, right?
Sorry, repeat the question.
I mean, so as I understand it, then your real objection today is the targeted proposal to spend dollars on treatment activities for specific systems before the regulations tell you what you got to do.
And it potentially won't reflect the most prudent approach to the entire state.
Okay, I'm going to leave it alone at that, and I'll probably ask the same question of Mr. Junis, and I'll ask the same question of the company on rebuttal. So they already know what the question's going to be, and I don't have to make the comment a second time. Thank you.
Mr. Hauser, so you just referenced not knowing the extent in which systems and working on the addressing a specific system, but just in general, is it not true that at this stage we know that the PFAS and maybe the PFOA is everywhere and in everything? Can you just comment on that in relation to your previous answer?
So the compounds are widespread, that's true. But also the actual health risk of them at certain levels is yet unknown, as well as the risk assessment has not been released from the two entities that regulate Aqua North Carolina as far as environmental compliance.
All right. And so, going to the dreaded phrase coal ash, but coal ash happened over a very long number of years. And at some point along the way, just like we know now, there was anticipation and discussion the EPA would come forth with the rule. And that took a long time. So in this case, should the health effects or the negative consequences become, should more become known about that? How long is too long to wait on a rule when we know that the agency may be slow or have various impediments to doing that, yet still realizing at some point some sort of removal or cleanup will be required or expected?
I'm not sure.
So you don't have in mind at what point we would then hold the company responsible for knowing that this is a situation where chemicals in the water are have negative consequences for the customers and the consumers.
I do not.
All right. Ms. Berger has mentioned in the rebuttal that there may be funding available from the bilateral infrastructure legislation. Do you have any information on what might be available anymore?
As far as project funding, I do not. I defer you to witness Junius.
All right. And does having knowledge that that funding might be available change your position about whether it's reasonable for the company to go ahead of a compliance deadline?
I would think that they would still need to develop a holistic plan to approach the entirety of the state of North Carolina.
And even if they could make some progress and have those funds in hand, and those funds may not be forever available, would your answer still be the same? All right.
Yes.
All right. And then Ms. Berger stated in her rebuttal that the public staff had not recognized that Aqua's wastewater facilities are small and are not designed or constructed to achieve 100% compliance rate like the larger municipal systems. Do you agree with that statement?
Sorry, you said that. Could you repeat the question?
Yes, I will. That Ms. Berger in her rebuttal had stated that the public staff had failed to recognize that Aqua's wastewater facilities are small. She called them like grade 1 through grade 3 rated facilities that are not designed or constructed to achieve 100% compliance like the larger systems, like the larger municipal systems. Does the public staff agree with that?
I would agree with you that the systems or the wastewater treatment facilities are small, but I can't speak to the design criteria for them.
All right. And then looking at Aqua's NOVs from August 2019 to July 2020, you've characterized them by by effluent parameters, sanitary sewer overflows, and failure to monitor. Would it be possible to determine which of these NOVs trigger a specific facility into a significant noncompliance?
I'm not exactly sure at this time which facilities are near the line with significant noncompliance as far as what criteria that entails. But I would imagine that with that information, it would be possible. We would need more background information for each system, I would think. So I'm not entirely sure.
And what about the penalties that would be issued by DEQ?
So for a penalty, not all the DEQ first has, or you're speaking about penalties specifically for wastewater systems. So
Yes.
generally DEQ issues a notice of violation intent to assess a civil penalty to systems that they then plan to assess a civil penalty to. It's my understanding that they don't always send a civil penalty when they notify the system that they have an intent to assess a civil penalty. But I do believe that they're required to make that step as notifying the system of the intent prior to sending the civil penalty.
Is there any way, and do you know whether there's a correlation between the penalties and the significant noncompliance?
I do not.
All right. Any other comments? All right. Are there questions on commission questions?
Yes, thank you. I have a couple. Mr. Hauser, how many systems did you review? How many of Aqua systems did you review when you were preparing your report or your testimony
Specific,
with respect to PFAS, PFOA? I'm sorry.
I'm not understanding your question.
Did you look specifically at the Aqua systems when you were formulating your view about this holistic effort you say they should undertake and have not undertaken?
I didn't look at specific systems, but no, I did not look at specific systems.
Well, I do need for you to help me on this, please. So do you know what kind of analysis they've done of the specific characteristics of their various systems?
I know that they have looked at they've conducted sampling on their systems, and they have looked at their systems which have samples on a running annual average which exceed 13 parts per trillion.
Right. And do you know which systems those are? I mean, have you looked at them? Have you looked at those reports and that information?
I don't believe that I know exactly which systems they're associated with, but I do understand that the company sent us a number of systems with sampling information.
So how do you know whether they have adequately surveyed their systems?
Excuse me, the public staff did ask the company to give us information on, or we asked for information in data request 66 for the 10 projects where the company was intending to install PFOS and PFOA filtration, and they did provide information on the specific locations.
So you have looked at the results with respect to 10 systems. Is that correct?
I'm not sure if the number is exactly 10 systems. I believe they included a larger number than 10 systems in those projects.
Do you know what that larger number is, even approximately?
Subject to check the numbers between 10 and 20.
10 and 20. And that's out of how many systems? I should know that. I'll see if you can.
Say that again.
That's out of how many Aqua systems? Subject.
Approximately 738. Subject to check.
So you know something about the results with respect to 10 or 20, but you don't know anything about whether they have performed such analyses on the others. Is that right?
I believe the company informed us in their data response that they had sampled the other systems.
Good.
Or it may be in Ms. Berger's rebuttal.
Okay. Speaking of Ms. Berger, have you, in your preparation for this or in just your regular analytical work at the public staff, have you met with Ms. Berger to discuss the company's approach to these issues?
I have spoken on the phone, but I don't know.
Mm-hmm. Have you discussed with the company I'll call it the corporate efforts that Aqua and Essential have focused on this matter?
Mr. Hauser, be sure to speak up.
Sorry. No, we haven't spoken about the corporate policies other than I spoke with Mr. Melton. He let me know that they had adopted them, and that was reflected in the company's data request response.
And so corporate policies, would you agree that to include in that the corporate efforts towards trying to focus on solutions for PFAS and PFOA?
Sorry, repeat your question.
I'm trying to establish whether you, in the course of your investigation or in the course of your regular activities, have availed yourself of the ability to understand what Aqua and what Essential are doing on a corporate basis to address the PFAS and PFOA issues.
Not at the corporate level.
Okay.
I would just like to object. I'm not clear what commission question Ms. Sanford's question was occasioned by.
I'm sorry, I should have linked it up to a commission question. What I was working off of are the questions principally by Commissioner Clodfelter with respect to whether it is sensible to go ahead and do some things in advance of having, these are my words and certainly not yours. I'm paraphrasing poorly, but the extent to which it's sensible to go ahead and perform activities in anticipation of an ultimate understanding of what all the facts are. And I'm trying to understand what the public staff has done with respect to that kind of inquiry.
Could you ask the question again?
Well, was it all of them that was? My last question.
The last one, please.
My last question was whether either in the course of your ordinary activities or in preparation for your testimony in this case, you have availed yourself of an understanding of what the company, including on a corporate basis, is doing to focus on PFAS and PFOA issues.
Sorry, I'm sorry for asking you to repeat. Could you please repeat yourself?
I will, and let me try to break it down. First of all, I'm interested in what you do in your ordinary, in the ordinary course of your job assignments, or what you have done in preparation for this hearing to understand what Aqua's corporate-wide approach is to addressing the PFAS and PFOA issues.
We've not evaluated the corporate approach, or not to my knowledge.
Same question with respect to North Carolina.
We've reviewed the company's proposed projects for North Carolina and the associated criteria that they submitted to us through our data requests.
Okay, thank you. No more questions.
And the objection is overruled.
All right. So you received several questions from the commission, principally from Commissioner Brown-Bland, about the fact that PFAS is everywhere, or this knowledge that it's everywhere, and the health concerns attendant to it. Is drinking water, the only source of PFAS contamination?
No.
What other sources are you
So
aware of?
the EPA typically for water uses a relative source contribution of 20%. There have been some industry presentations that have said that 25% of the intake of a contaminant comes from water, and that the other 75% could be attributed to diet for PFAS, PFOA compounds.
Okay. And these questions that you were asked on the topic of PFAS, is this an issue that you addressed jointly with Mr. Junis?
Say that again?
Is the issue of PFAS and how the company is addressing it an issue that both you and Mr. Junis testify about?
Yes.
And you discussed regulation of PFAS, is that correct?
Yes.
And Mr. Junis addresses the capital projects that the company has planned to address it.
Correct.
All right. I don't have any further questions.
All right, then I will take motions.
I move that public staff Hauser exhibits 1 through 3 be entered into evidence.
All right, that motion is allowed. The exhibits are received into evidence. All right, Mr. Hauser, you may be excused. And Sanford, you move into the mic.
I am. If now is a good time, I could take this opportunity to ask that the various items we discussed earlier be admitted into the record.
Let's take care of it.
Okay, I think we can do it in 4 minutes, maybe less. I'm going to go through the list on the docket. Starting with Aqua's application and the various exhibits, appendices, et cetera, excuse me, that were filed with that on June the 30th, 2022.
All right, without objection, that will be received. The application will be received into evidence.
And I had other items, so I'm just going to go through them one by one. Okay. Aqua's supplemental filing of July 20th, 2022.
Right.
I'm sorry. Aqua's motion on the hearing schedule of August 16th
You need that received into evidence? That's in our file.
Okay, that's right, that's right. The, Aqua's report on customer comments from the public hearing held in Raleigh of October 24th.
Right?
I'm going to back up chronologically because I need to include Aqua's updated filing information of October 21st. Aqua's report on customer comments from the virtual hearing held on October 20th.
And yet that was filed.
Yes, on November the 9th. Aqua's report on customer comments from public hearings held in Wilmington and Gastonia, filed on November 15th. Aqua updates filed on November 18th. And I believe that is I believe that is where we'll stop for today, if that's okay.
I
We'll
had
have
an information update on September 20th. Is that one?
September 21st. I am so sorry. I'm making this harder than it needs to be.
That's right. It is the 21st. All right. So the supplemental filing on July 22nd, to be clear, will be received into evidence. Aqua's 3 customer reports filed on 10/24, 11/9, and 11/15 will be received into evidence, and the information update from October 21, 11/18, and September 21.
September 21, and there was another update.
I think we had 3. You had 3.
3,
I
okay,
got 3.
okay, that's right.
They will be received into evidence.
That's right. Thank you very much. Thank you for your patience.
All right. So we will recess through the day and we will start in the morning at 9:30.